financial industry is undergoing a profound transformation, and digital technologies are reshaping payments, lending, insurance, and wealth management. The rapid development expects financial services in many economic sectors to be more diverse, competitive, efficient, and inclusive. The COVID-19 pandemic has accelerated the digital transformation in the economic sectors. In particular, the need for digital connectivity to replace physical interaction between consumers and providers and in the process that produce financial services will be even more critical as economists, financial service providers, businesses, and individuals navigate the pandemic and eventual post-COVID-19. Development of fintech and digital financial services is supported by the increasing internet access and smartphone users in Indonesia. With the collaboration between the government, industry, and stakeholders, we believe that innovation will be created in the digital financial service and fintech ecosystem, supported by good governance and digital financial education and literacy in the community. Together with all stakeholders, Indonesia Financial Services Authority (OJK) organized Indonesia Fintech Summit 2021 from 11th November to 12th December 2021. Indonesia Fintech Summit 2021 is delivered through virtual platforms by presenting more than 70 various promotions, 90 more educational and literacy activities, more than 50 fintech companies, and more than 200 job vacancies at the 2021 virtual job fair. More information regarding the agenda related to the Indonesia Fintech Summit 2021 can be accessed through the official website www.fintechsummit.co.id.
Berbagai kasus kejahatan terjadi di Indonesia. Salah satu alasan pelaku melakukan kejahatan adalah karena mereka bisa menikmati hasil kejahatannya dengan leluasa. Hal ini dilakukan melalui pencucian uang, yakni upaya menyamarkan uang hasil dari tindak pidana sehingga tampak sebagai harta kekayaan yang sah. Pencucian uang biasanya diawali dengan penempatan uang hasil kejahatan ke sistem keuangan, lalu uang yang sudah masuk ke dalam sistem keuangan tersebut dipecah dan dipindahkan ke berbagai instrumen keuangan. Pada akhirnya, dana hasil kejahatan tersebut menjadi samar dan seolah tampak seperti harta kekayaan yang sah, dan kemudian uang hasil kejahatan tersebut dapat dinikmati. Publik dikejutkan oleh berbagai kasus terorisme. Selain itu, di dunia ini juga terdapat ancaman berupa pengembangan atau biasa disebut proliferasi senjata pemusnah massal. Kegiatan terorisme dan proliferasi senjata pemusnah massal ini dapat berlangsung karena adanya pihak-pihak yang mendanai. Jika dibiarkan, pencucian uang dan pendanaan terorisme berdampak buruk bagi Indonesia. Mengganggu rasa aman dan kedaulatan Negara Kesatuan Republik Indonesia, menghambat pertumbuhan perekonomian, mengganggu stabilitas dan integritas sistem keuangan Indonesia. Indonesia memiliki landasan hukum yang kuat untuk menghadapi tindak pidana pencucian uang dan tindak pidana pendanaan terorisme. Berdasarkan Undang-Undang Nomor 8 Tahun 2010 tentang pencegahan dan pemberantasan tindak pidana pencucian uang dan Undang-Undang Nomor 9 Tahun 2013 tentang pencegahan dan pemberantasan tindak pidana pendanaan terorisme, setiap pihak yang terlibat tindak pidana pencucian uang dan tindak pidana pendanaan terorisme akan dikenakan sanksi pidana dan sanksi administratif. Masyarakat juga perlu berhati-hati dan memahami adanya potensi menjadi pelaku pasif apabila menerima atau menguasai penempatan, pentransferan, pembayaran, hibah, sumbangan, penitipan, penukaran dari dana kejahatan, namun tidak memberikan informasi ke pihak berwenang. Masyarakat dapat berperan aktif dalam rezim APU PPT dengan menghindari aksi titip transaksi keuangan, menjaga identitas pribadi agar tidak disalahgunakan untuk bertransaksi oleh pihak yang tidak bertanggung jawab, mendukung dan mengikuti proses prinsip mengenali pengguna jasa yang dilakukan oleh lembaga jasa keuangan secara kooperatif, memberikan informasi kepada PPATK jika mengetahui adanya perbuatan yang berindikasi pencucian uang, pendanaan terorisme, dan pendanaan proliferasi senjata pemusnah massal, mengkonfirmasi dan mengecek lebih mendalam atas aktivitas penggalangan dana. Rezim anti pencucian uang dan pencegahan pendanaan terorisme atau APU-PPT Indonesia ada untuk mencegah dan memberantas tindak pidana pencucian uang, pendanaan terorisme, dan pendanaan proliferasi senjata pemusnah massal, serta untuk melindungi masyarakat. OJK sebagai lembaga pengawas dan pengatur sektor jasa keuangan terus bekerja meningkatkan efektivitas penerapan program APU-PPT. Sektor jasa keuangan dan masyarakat menjadi garda terdepan yang harus selalu awas dan peduli. Mari perkuat rezim APU-PPT di Indonesia.
Excellencies, distinguished guest speakers, ladies and gentlemen, good morning and good afternoon to everyone. Welcome to Fintech Research Symposium 2021, hosted by Indonesia Financial Services Authority, supported by Center for Fintech and Banking, Universitas 11 Maret UNS Fintech Center. Before we proceed further, I would like to invite our distinguished speakers, guests, ladies and gentlemen, to stand up on your position for singing the national anthem of the Republic of Indonesia, Indonesia Raya. Please all rise. You may be seated. Thank you. Distinguished speakers, guests, ladies and gentlemen, I would like to greet and give a warm welcome to our invited speakers, Dr. Inka Yusgiantoro, Head of Research Department in Financial Services Sector, Indonesia Financial Services Authority, Professor Alistair Milne from Liverpool University, UK, Professor Jonathan Williams from Bangor University, UK, Dr. Francesco Saverio Stantella Lopez from University of Bologna, Italy, and also Dr. Ruth Tuckning from Université de Limoges, France. First of all, it's really an honor for me to be your MC and also your moderator for today's agenda. Allow me to introduce you. My name is Tiffany Ratama from CNN Indonesia. I would like to extend a very warm welcome to all of you here. We really appreciate that you're taking time of your busy schedules to join us today. And thank you once again for joining us on Fintech Research Symposium 2021. It's an annual agenda of Indonesia Financial Services Authority, OJK, that brings experts and also world-class professors to disseminate research in the field of financial technology, banking, economics, and also finance. And for all participants' information, today's forum is also broadcasted live on Jasa Keuangan YouTube channel. To begin with, I would like to invite Bapak Hermawan Sasongko MBA as Deputy Commissioner of International and Research Indonesia Financial Services Authority to deliver his welcome remarks. Please welcome Bapak Hermawan Sasongko MBA.
Yes, thank you. Thank you, Pak Tiffany. First of all, I would like to apologize since that's our chairman from OJK could not join in this event today, since he has to had a meeting with the parliament in a very specific meeting today. So I would like to deliver and read the keynote speech from our chairman. Distinguished speakers and researchers, Prof. Alistair Milne from Liverpool University, Prof. Jonathan Williams from Bangor Universities, Dr. Ruth Tuckning from the University of Limoges, Dr. Francisco Saverio Stantella Lopez from University of Rome, our research partner, Dr. Iwan Trinugroho from UNS Fintech Center, Dr. Inka, of course, from OJK, all participants, ladies and gentlemen. Good morning to our speakers in Europe, and good afternoon to participants, to the speakers in Indonesia. I am delighted for the opportunity that allows of all of us together in this event. It is a great pleasure for me to welcome all our distinguished speakers. I would also like to thank OJK Research Department and UNS Fintech Center who helped organize this very important event. As we all know, the COVID-19 pandemic has become a momentum for accelerating digital transformations. This is due to technological developments that are inevitable and have become an integral part of the global community. The theme of today's event is therefore timely, as we are in the midst of transitioning to digital world. In this regard, I would like to explain OJK's policy in accelerating digital transformations in the financial service sectors through utilizations of our demographic advantage of the digital economy in Indonesia. Before we start, please allow me briefly explain about Indonesia Financial Service Authority, which is also known as OJK. OJK is an integrated supervision authority mandated with the duties of regulating and supervising banks, capital market, and non-bank financial institutions, as well as protecting consumer or financial service industry. This is in line with increasingly blurred boundaries between sectors in the financial services as a result of digitalizations. Nowadays, consumers expect to be able to access all kinds of financial services at their convenience using smart devices with fast service, response, and affordable price. OJK was established in 2011 as a new institution that carry out supervisory role previously assumed by two institutions, namely Ministry of Finance and Bank Sentral of Indonesia, Bank Indonesia. This year, OJK celebrate a decade of establishment. The institutions now employ around 4,000 employees, which dominated by millennials, dispersed in over 35 regional and branch offices all over Indonesia. Distinguished speakers, guests, ladies and gentlemen, as we know, the COVID-19 pandemic has been lingering for almost 2 years with major impacts on various aspects of our lives, especially economic, financial, and community mobility. The presence of technology in all aspects of people's life provide great benefits, especially in accelerating economic and business activity, as well as exchanging information both domestically and across countries. With the advanced technology available nowadays, there is no limit to the dimension of space and time in communication utilized by communities. Financial service transactions can be carried out anytime, anywhere. It is without doubt that Indonesia offers enormous potential for the development of the digital industry. As an archipelagic country with a population of 272 million people dominated by millennials, Indonesia needs fast, efficient, and easy access to the financial sector products and services. Given its growing middle income class and technology-savvy populations, Indonesia digital industry has been expanding rapidly across the country. 2,319 startups, including 1 decacorn, and 7 unicorns. Indonesia is home to more than 65 million MSMEs, of which 70% of them need technology support to develop their business. In addition to ease of communications, there is a shift in people's preference and behaviors toward digital means, which encourage the growth of startup and essential sectors such as health sectors, agriculture, education, and financial. So health tech, agri-tech, edu-tech, and fintech. This is apparent as digitalization has added the convenience of doing business in producing and distributing goods and services for wider community in obtaining it. As we can observe in Indonesia case, digitalization in finance has already left a strong imprint in the financial service sector, and all signs point of even more sweeping changes ahead. Therefore, OJK policy in accelerating the implementation of digital transformations in the financial sector focus on two strategic things. First, supporting the use of digital technology in the financial service sector with an aim to provide services and products to the public in a quick, affordable, and competitive manner. And the second, offering convenience and enhancing access for the unbanked and MSME entrepreneurs to various digital financial products and services. Distinguished speakers, guests, ladies and gentlemen, we have a published number of roadmaps and policy to encourage digitalizations in the financial sectors. First is the Indonesian Financial Service Sector's Master Plan 2021-2025, which focus on accelerating digital transformations. And second, the Digital Finance Innovations Action Plan 2020-2024, which focus on developing a supported and comprehensive digital financial ecosystem to create financial service industry that is competitive, resilient, and fit for the futures. In the banking sector, OJK regulations on digital banks provide space for banks to enter into digital ecosystem and develop digital-based bank products and services for both large and small-scale banks, such as rural banks. Currently, OJK is also developing the policies to support the insurance industry to move forward and form synergy with other financial institutions through digitalizations in insurance marketing systems as called InsurTech. OJK builds an integrated digital-based MSME ecosystem from upstream to downstreams to support digitalizations of MSME through providing a greater access from MSME players to access alternative financing through fintech peer-to-peer lending and security crowdfunding. The same opportunities is also over for microfinance institutions, including those called as micro-wakaf banks. Recently, OJK also worked with the Indonesian Fintech Lending Associations to lower P2P lending rate cap to support higher MSME financing in the future. Providing guidance to FSME by collaborating with the startup and universities, such as through MSME Campus, which provide intensive trainings with an objective accelerating MSME to get on board on digital platform and become more savvy in taking advantages of financial technology and digital finance. Those policies provide great benefits to the community, as indicated by higher level of financial inclusions in 2019, which was recorded at 76.19% compared to 2016, which stood at 67.8%. We are optimistic that by 2024, all of these OJK policies can help increase the financial inclusion level to reach 90% as targeted by the President of the Republic of Indonesia. On the digitalizations, the financial sector, OJK will proactively take policies to mitigate the risk arising from digital transformations. The policies covers personal data security and cybersecurity risks that will be monitored through coordinations with law enforcement agencies. Given the uncertainty and challenging times ahead, we need to be flexible, prompt, and forward-looking to respond to a fast-changing environment. The actions that have been taken by OJK are the result of better utilizations of evidence in policies and practices. Hence, we have been promoting evidence-based research in our decision-making policy that are preemptive and forward-looking for the Indonesian financial service sectors. In this regard, insight from prominent experts in finance and financial technology that we will be shared today will greatly support policy-making process in financial technology and digital finance, and help ensure that OJK regulations and policy are in line with global best practices. Distinguished speakers, guests, ladies and gentlemen, finally, I believe this discussion will not only enlighten us with forward-looking ideas in financial technology and digital finance, but will also help us transform financial services through digitalizations that could better support post-pandemic economic recovery. Again, my great appreciations and gratitude go to all our distinguished speakers and participants for their gracious participations and contributions to this event. I wish you all have a productive and fruitful discussion. Thank you very much. Jakarta, December 10, 2021, Wimbo Santoso, the Chairman of Indonesia Financial Service Authority. Thank you. Thank you, Ma.
Thank you very much, Bapak Hermawan Sasongko, for delivering the warm remarks for us today. And next, I would like to invite all speakers join with Bapak Hermawan Sasongko to taking a virtual photo session. So please make sure and prepare on your position. And to all participants, you may join to this virtual photo session by turn on your camera. Okay, so please prepare on your position. Are we ready now? Okay, perfect. Count down by me in 3, 2, 1. Wonderful. Once again, thank you very much, Bapak Hermawan Sasongko, for delivering the welcome remarks. Distinguished guests, ladies and gentlemen, for your information. So all participants in this forum will receive online certificate by filling out the attendance form. So this attendance form will be shared by committee in the Zoom chat box and will be shared in the plenary discussion, in the second plenary discussion. So we really hope that all participants to stay and join the forum until the end. Ladies and gentlemen, we arrived in our plenary session, but I will give some additional information. Today, we will have 2 plenary sessions. 3 speakers will deliver their research in first plenary session, and 2 other speakers will deliver their research in second plenary session. Before I introduce our speakers for the first plenary discussion, I would like to remind all participants that you also can participate in this plenary session. If you have questions, please feel free to drop your questions through the Q&A feature with format name, institution, to whom the question is addressed to, and what is your question. And additional notes to our speakers. Each speaker have 20 minutes. Each speakers have 20 minutes maximum to deliver the presentation, to deliver the research, and to find out the remaining duration, the speaker can see the time reminder on the screen. And after each speaker deliver the presentation, we will have a short 20 until 30 minutes for Q&A session. And as I mentioned earlier, Today we will have a very fruitful discussion. We have lined up for you to be fruitful and, of course, engaging. We have 5 invited world-class professors that will be presenting their research in the field of financial banking, technology, finance, and also economics. So for our first plenary session, we will start our first plenary session. I would like to introduce you our first speaker for this first plenary session. We have Professor Alistair Moon from Loughborough University, UK. Professor Alistair Moon is a professor of financial economics at School of Business and Economics, Loughborough University, UK. And his education background, he has PhD from London School of Economics, and his research interests in bank capital, financial risk management, central banking, payment, clearing, and also settlements. And today we will hear research from Professor Alistair Moon about, okay, let me check, about financial technologies and financial regulation. Okay, please welcome Professor Alistair Moon. Okay, hi, Professor Alistair. I think I still cannot hear you. So have you already unmuted it? Hi. Hi, Professor Alistair. Yes, I still cannot hear you. So can you check the audio first? Oh, I think we have trouble communication because I still cannot hear you. Am I the only one who cannot hear Professor Alistair? Okay, maybe from control room, can you check what's happened with the audio? Clearly I can see you. Yes, but I cannot hear you. Okay. Maybe from the control room, can you help find out what happened with the audio? Okay. Oh, let me check the chat. Yes. I think you have problem with your microphone. Okay. Then while we're waiting for Professor Alistair to check what's happening with his microphone, is it fine if we move maybe to our speaker? Oh, okay, that's great. Okay. Next to our speaker. For the first plenary session, we have Dr. Francesco Saverio Santalla Lopez from University of Rome, Italy. Dr. Saverio Lopez is a lecturer from Department of Business Administration, Rome University, Italy, and his education background, he had PhD in finance from Tilburg University and Rome Tor Vergata University. His papers published in some book chapters, such as book chapter in Disruptive Technology in Banking and Finance, an international perspective on fintech, and also published in some international reputable journals, such as Journal of Financial and Quantitative and Journal of Banking and Finance. And his topic about okay, let me check it. Oh, I haven't received what is the topic presentation, but okay. Please welcome Dr. Francesco Saverio Santalla Lopez.
Thank you very much. Hi. So I'm going to talk today about the premium of Bitcoin futures. So thank you very much for giving me the opportunity to talk about this interesting topic today. So I share my presentation now. Sorry for not having sent it before. Here it is. So today I want to speak about this very interesting topic in the literature and in the academia. So I'm going to talk about this this premium that is going for Bitcoin futures. We know that. So the question I want to and I'm trying to address in these days is basically what do we know about the premium paid by Bitcoin futures?
Recording
so we know
in
that
progress.
the futures of the market for futures on Bitcoin is becoming very, very large. Currently, basically accounts for about 6 billion. I mean, not 6 billion, but 5.6 billion in US dollars. So it's a quite large market. And basically, we have these instruments trading in markets, I mean, in exchanges like the Chicago Mercantile or the CBOE. And basically, they are... They have introduced this kind of contracts in 2017, but of course we know that these contracts have been trading in other exchange like Binance or FTX, which are classical, I mean, cryptocurrencies exchanges. And so what do we know about, because these are instruments that are basically a bit different than what we usually, I mean, trade as futures. We normally trade as commodities or currencies, this kind of underlying assets. But I mean, when we move from the classical, let's say, underlying to something like a cryptocurrency, something like Bitcoin, I think something would be different. And of course, if we look at things like the convenience yield or the implied yield in the future prices, we basically can see that there is something, I mean, different going on with this instrument. So let me clarify. So first of all, which one is why is important to talk about this? Well, it's important to talk about this because we have like standard exchanges like the Chicago Mercantile Exchange, which already, I mean, it became, I think, in the last couple of weeks, the largest exchange for Bitcoin, for futures on Bitcoin. But still, we have many other exchanges. I mean, here is just an overview or about all the exchanges that basically are allowing investors to negotiate these instruments. And we have the Chicago Mercantile Exchange as being the most prominent and the most important one, of course, followed by Binance and FTX. So why it's important to talk about this? Well, we have a growing literature about this, and this growing literature has faced, I mean, many important topics about Bitcoin. We have basically the recent paper. I mean, all of them are very recent paper, very recent research going on about Bitcoin, because the reality is that we don't really know a lot of things about this instrument. We know, I mean, of course, it's always on the news. Everybody's talking about it, but we still don't know. We're still not sure about what are the real determinants. Of course, I mean, in people in finance, especially academics, we like to talk about fundamentals. I mean, the people, the things from which the value should arise. I mean, what engendered the value of an instrument. And with Bitcoin, it is not still clear. Of course, if you read around, you will see that basically Bitcoin, the price of Bitcoin is based on supply and demand, blah, blah, blah. Of course, I mean, we know these things. We know that basically it's traded, and actually people are trading these instruments at a very high price, but we're still not entirely, I think, understanding the real core of Bitcoin, the real value, where this value is coming from. And basically, we have some very interesting research. I mean, I cited here just some of the papers that I believe are the most important to understand a little bit Bitcoin. The first one is basically just a theoretical paper, which basically shows which is the basically history of Bitcoin and why Bitcoin moved from like a mining based instrument to something that is more, I mean, devoted to the market and more market oriented, especially when the importance that basically transaction fees are going to take in the future of Bitcoin. And also we have basically some evidence already that there have been some price manipulation in the Bitcoin ecosystem. These are especially, I mean, we all know the history of one of the most important stable coin, which is Tether, that has been basically cited. That has been, I mean, they had basically a long history of, I mean, not being completely transparent in what their reserves are and what is really going on with this token. So of course there are people that believe that some kind of price manipulations are going on in the Bitcoin ecosystem, but we're not sure again if this is the whole story about it. It probably is not, in my view. So, and finally, I mean, we have also a recent paper showing that there are some kind of price inconsistency, because I mean, when we look, I mean, in finance, when we look at price, we really like to assume that there is this absence of arbitrage in the markets, meaning that if you can't make profits if you're not risky, if you're not risking anything. And basically in the Bitcoin ecosystem, this has been proved not to be the case. In particular, there is this very nice paper on 2020 from Markov and Square and Antonio Square showing that basically there could be some arbitrage opportunities, especially when we look at cross-border exchanges. But today, I'm not focusing like on the spot market. I want to focus on the future market. In particular, what I want to look at is the difference between the spot market and the future, and the spot price and the future price. What we normally refer to as a basis of the future. So, I mean, here I've used, of course, you can take the data from this Bitcoin futures from many different sources. I mean, as I mentioned at the beginning, there are many exchanges that basically provide data about Bitcoin futures, and from all of them, basically you can get data. I just took data from one of those, which is the Deribit, which allowed me to get the highest frequency. Those are mean price at a minute level, so every minute in the last months. And I took two instruments. One is basically a perpetual future, which is nothing but an instrument that tracks the spot price of the Bitcoin, and the other one is basically a future which is still not expired, so is going to expire in March 2022. So if we look at the price of a Bitcoin, the price of a future, any future, that should be priced according to this formula, will be basically we just basically taking the value of, taking the value of the price of the spot price of the underlying asset today, and we basically going to get some value for waiting to receive the value in the future, and then basically this is coming from the free risk interest rate. So that's why we have the second term, which is the exponential of the RT, which is where R is basically the risk-free interest rate. So this formula is coming directly from the assumption of absence of arbitrage, because of course if you at the same time if you have a discrepancy in prices, if you short the future and buy the spot price, you are in a hedged position, so you should basically receive only the free risk interest rate for the time you're waiting for. So for this formula, if we get both the spot price and the future price, it's possible to extract the yield of this position, and this yield should be pretty much aligned with a risk-free interest rate. Of course, I mean, we can think about many other. We can think about other things that can enter into this potential evaluation, and those are things like the convenience yield, or potentially some fees we have to pay to keep our position open, and so on and so forth. So, I mean, it's still what I want to show is more a question than actual fact. So I want to show you an empirical regularity, and then I still don't have the answer. It's still an ongoing research, so I can't tell you where this premium is coming from. But what I can show you is basically that, I mean, when we look at the difference between the spot price and the future price, the spot price would be the gray line here, and the future price, I mean the March 2022 expiring future is the black line here. As you can see, I mean, especially at the very early when this future was issued, there was a large, very large discount. Very large, I mean, spread between the spot price and the future price, and this has been basically reabsorbed over time. But as you can see, basically, the basis again varied quite a lot. And if we do this very simple empirical exercise, and we try to calculate basically what is the yield implied by this spread, we got these numbers here. And basically, as you can see, these numbers are quite large, because even if they seem quite small, actually they are daily interest rates. So every day you should be able to get this amount, and if you compound that basically on a longer time horizon, these are going to be very large interest rate, very large basically yields. So to conclude now, I just want to raise some questions and to ask basically, where is this premium coming from? What is a convenience yield? So is the fact that basically owning the spot product, basically the Bitcoin give to people some convenience, and that's why basically this premium is there? Or is it something related with the structure fees of each exchange? So something that basically might create again some arbitrage opportunity across exchanges. I mean, this is something that we're still working on. I think it's very interesting because, I mean, that could shed some light about what are the real determinants of the value of Bitcoin. If you, once again, we still, I mean, haven't grasped yet what the real value of Bitcoin is. Of course, if you think, I mean, many people believe that Bitcoin is it's really valuable, and its value is going to increase in the future. And this basically resembles what in economics has been always believed to be like a rational bubble, when basically you believe that something is going to increase in the future. Has been a lot of talking about this kind of bubbles in economics, but again, not sure about this. I mean, we can't really say anything if there is some kind of real fundamental that is creating this value, or if it's just a rational bubble or another kind of bubble. We still don't know that. And I think, I mean, looking at this empirical regularity might shed some light about the real price, the real value underlying the Bitcoin. So thank you very much for your attention, and if you have questions, please.
Perfect, excellent. Thank you. Thank you, Dr. Francesco Severius and Lopez from University of Trade. It's very interesting hearing about your presentation, of course, about Bitcoin. I have a question that maybe we will open the Q&A after our speakers in the first plenary discussion done with their presentation. Thank you once again. Okay, so for the next speaker, since Alistair is already done and with the audio, so our next speaker, our next presentation will be delivered by Professor Alistair from Loughborough University, UK. His topic presentation is about financial technologies and financial regulations. Okay, so please welcome Professor Alistair.
I think I fixed the browser. Can you hear me now?
Yes, yes.
Okay, good. It's a very small technical. Let me share my screen.
Yes.
Okay, so this is the title of my presentation, Financial Technologies and Financial Regulation. I'd first like to thank my two co-authors, my colleague David Llewellyn, who's an emeritus professor here at Loughborough, and Chuzu He, who's a younger colleague, former PhD student, who's now at the University of Bath. The inspiration or motivation for this paper comes from, I think, a quite well-known working paper by Thomas Philippon, some work he published around 4 years ago. The paper's title of Philippon's paper was The Fintech Opportunity. And I think his argument is quite well summarized in this short quotation. Fintech can improve financial stability and access to services. So exactly the kind of goals which we heard about in the chairman's speech about reducing barriers to financial inclusion, and developing financial services. But, and this is Philippon's point, this requires significant changes in the focus of regulations. We agree, but we've analysed this further, and we want to sort of build on his original argument. And Philippon's key point is that regulation has often actually been about protecting incumbents and resisting innovation rather than supporting innovation. But fintech is actually an opportunity to improve the way all aspects of financial services operate. So we explore more fully this issue of what are the established approaches to financial regulation, and are these still appropriate in the face of the current rapid pace of innovation? So the kind of questions we're looking at: do the existing regulatory instruments work appropriately? Are they the necessary tools for the new technology-based financial products and services? Is there enough attention to competition and barriers to entry? And then what new approaches are then required? So there is a substantial literature which we draw on, and my co-author David Llewellyn is amongst the prominent contributors to that literature. There's a few of the prominent scholarly articles noted below, and what that literature highlights are two core objectives which have over the course of the 20th century were established as the main goals of financial regulation. So one is conduct of business. So that's about protecting consumers, protecting investors. It's also, in the context of markets, about promoting market integrity, preventing market manipulation. So that's one set of concerns. And then the other, of course, which probably receives even more attention, are the prudential objectives around the safety and soundness of individual firms, but also, of course, containing systemic risk and protecting the essential financial services such as payments, the provision of credit to support business activities. That's not the whole story of financial regulation. There are, of course, a whole lot of other responsibilities. Over the last 40 years, we've had a lot, banks in particular are given extensive requirements to conduct KYC and anti-money laundering reporting. Financial inclusion is typically an issue for most regulators. Financial development in low income and emerging markets, and competition law is sometimes a concern. But still, the core objectives, the ones that are highlighted everywhere, are these two: conduct of business and prudential. So that's the question: are we as we pursue these two objectives, are those sufficient when we're looking at the new financial technologies? Now, to bear in mind, and I think there are others who can talk at greater length about the impact of new technologies, but I'd like a quick summary. First of all, there are building blocks. Obviously, the digitization of data, the access to data through the internet, and the opportunities that provides for big data, for using data from many sources quickly in large volumes. The development of computational tools, which have, that's not totally new, but advances in computer capacities now allow a whole new range of techniques, machine learning, image recognition, and others. The general term artificial intelligence is a popular one. And what are those innovations then supporting? So we draw a distinction, I think it's not entirely ours, but I think it's an important one, between two forms of innovation. So one are enhancing innovations that can be used to improve operations, reduce costs, improve services to customers. And examples would be addressing fraud in operations, improving the speed of services, supporting new payments channels. but those are still enhancing what are essentially existing services. More profound are the challenges that arrive from transformative innovations. So innovations are either enhancing or transformative, and that's given rise, I think, to two broad challenges. New intermediary business models, which are, entirely, they may, an obvious example would be, for example, peer-to-peer lending or alternative foreign exchange providers. So these are new businesses which are providing what we think of as banking services, but they're not themselves banks. And therefore, that's a challenge for regulation. And of course, another set of challenges, and our previous presentation was focused on this, are the emergence of these permissionless crypto assets. So there's Bitcoin most prominently, but there are many others. There's a whole world of decentralized finance, sometimes referred to as DeFi, working on these blockchain ecosystems. And that's even more problematic because there are no intermediaries to regulate. So that as regulators, we now face this challenge of our old categories of banks, insurers, asset managers. Those are not as neat and tidy. There's many new players. And there's actually financial transactions going on which don't use institutions at all. And how do we think about regulating those? So the regulatory challenges, as we see them in this very novel landscape, is they're old, but they're also new. So conduct and prudential challenges are still there. Are the data and technology being used fairly? Is there sufficient protection of crypto investors? Is price discovery in capital markets being undermined by the new computer-based technology? So that's the kind of conduct questions. Prudential, is there sufficient oversight of these new intermediary business models? Could they be running risks which customers and clients are unaware of? And more broadly, could new entrants be undermining the income of incumbents? So could our existing banks get into trouble, and that could then hit our payment systems and the provision of credit because of the competition from the new intermediaries? And are there increased monocultures, or are there new booms and busts that are being driven by these technological possibilities? But those are old questions, but in new form. The new question, the one which I think is, and this is one of the main points of our paper, is that we have to take, if we're going to succeed in supporting innovation in finance while still addressing the traditional objectives, we have to pay greater attention to competition. So competition concerns will increasingly be a central issue for financial regulators around the world. And there's what we refer to as I don't know how many of us have benefited from classical education, but there's a Greek myth about Scylla and Charybdis. So it's a sailor faced with these two great dangers on one side or the other. On one side, there's the danger of preventing the innovation by disadvantaging the new providers, because you're trying to protect banks. But the other danger is allowing them to escape regulation altogether, creating conduct and prudential risk. So how do we get the balance of those two correct? So the core of our analysis is set out in this figure, and it looks a little complicated, but I'll take us through the figure, and then I'll draw some conclusions from this. So starting with the vertical divisions. So we highlight these three objectives: the established prudential and conduct of business, but also competition or competitive efficiency as being central. And then we say that how those are applied is going to depend on whether you're talking about an existing product or service, or whether it's a new product or service. On the horizontal, we're then considering whether it's an established intermediary, an existing bank or insurance company. So, and those are the enhancing innovations, when they're using innovation to improve what they're already doing, or possibly provide new products or services, or whether it's a new intermediary business model. And of course, the biggest challenges are when you've got new intermediaries providing entirely new products or services. And then as we work horizontally, we also point out this entirely new development of the last 10 years of 10 or so years of decentralized finance or crypto finance without intermediaries taking place at all. And that's clearly not an existing product or service, but it's an example of a new product or service. And we distinguish 5 different responses to these new developments. So regulators should think about these possibilities. So one is enhancing existing regulations. The second is adapting existing regulations. So that's really a question of whether it's an established model or a intermediary business model or a new intermediary. With a new intermediary, it's going to be necessary to adapt. At the same time, when we're addressing competitive efficiency, so the third one is that we may need, when it's a new product or service, we may need to develop a more appropriate form of regulation. We've also, in addition to those first 3, we need to think about competitive efficiency, and that's primarily a focus on reducing barriers to entry, especially technological barriers. And then the final response, which is quite a different one, but it's the way we believe is necessary to deal with decentralized finance, is actually establishing the regulatory perimeter. You can't directly regulate because there are no intermediaries, but you can regulate the boundary where there's interactions between mainstream or established finance and intermediaries and the decentralized world. So one other thing I'll point out in this figure, and I'll move on to it in the next slide, is it's important also to think about the distinction between functional regulation, institutional regulation, and what we refer to as market level regulation. Again, this is well established. Functional regulation is typically applied to conduct of business. So it doesn't matter who is providing credit, you should be protecting borrowers in a consistent way. It doesn't matter who is providing an investment product, you should have the same degrees of investment protection. So conduct of business should not depend on the institutions, it should be neutral across institutions. That's not true of prudential though, because the prudential regulation, it will be different for different types of institutions and indeed for different institutions to reflect the prudential risks they're taking. And then finally, and this is to deal with competitive efficiency, we need to think, and this is our second main argument, we need to think about a third level of intervention, the market as a whole. So this is summarizing what I've just said. We have functional regulation, which is already well established for individual products or services, primarily for conduct of business. Institutional, where we're concerned with prudential safety and systemic risk. And then regulation of the market as a whole, with a competitive efficiency objective in mind. And we're emphasizing the need for financial regulators to become much more substantially involved in market-wide regulation. The final part of our paper, so this is essentially where I'm going to finish, is to talk about policy. It's easy enough to set up the policy objectives. It's easy enough to say we have to use a new tool, which is a market level interventions, and to analyze where these tools should be applied. But actually the real challenge is about trade-offs and how do you balance one objective against another. And financial innovation creates new and quite difficult trade-offs for financial regulators. So yes, we have competitive efficiency as a third core objective, but there are very difficult trade-offs between competitive efficiency and in particular with prudential objectives, with prudential safety, with the safety and soundness of firms and protecting against systemic risk. That there are some trade-offs in the conduct of business and competitive efficiency as well, but they're much more limited. So we explore and discuss the challenges of balancing prudential and competitive efficiency. But we have, and that's a kind of warning, but we finish with a more positive recommendation, which is that a focus on market interventions can actually improve these trade-offs. So market interventions to reduce barriers to competition can at the same time lower barriers to entry, while also dealing with many of the major concerns about prudential risk. So we can give some examples of that. These are examples of market-wide interventions. Let me focus on two. So one is standardized market-wide record keeping. I particularly refer to the work of the Actors Foundation, who are a technology, a not-for-profit technology company developing standards in this area. And what they're trying to pursue, and I think this is an important point for all regulators, is that if we develop technology standards across all our institutions and markets, which are common to all areas of finance, then we're going to find it much easier to monitor prudential risk. But at the same time, that standardization is also going to lower barriers to entry and make it easier for fintech competitors to perform well. A second example, which is a research topic I'm trying to develop with other co-authors at the moment, is using technology to support orderly resolution of banks and other financial firms. If you can close down banks quickly and easily without disruption, then you can allow greater competition and not be so concerned about fintechs undermining the stability of banks. Other examples which are also relevant: banks have an excessive burden of KYC and AML. I think one of the things that's required to level the playing field, but also promote prudential safety, is for regulators to lead on the development of KYC AML utilities. So because these are market-wide costs, it's a public good. And I'd also point to the example of UK open banking. That's less concerned with prudential goals and more with competition. It's a good example of a market-wide intervention. Final point, I've just got a couple of minutes left, is the challenges of regulatory competition. So I referred to that already. The problem I've referred already to the problem that with crypto and DeFi, who exactly do you regulate? And our recommendation is about identifying the border between unpermissioned and permissioned activities. And wherever financial institutions engage with crypto and DeFi, that's where the focus of regulation must be. So it's on the permissioned institutions where you are working with known customers and can therefore protect them, known entities that you can regulate them from a prudential perspective. But that meets a challenge of regulatory competition. These unpermissioned markets, the permissionless markets of crypto and DeFi, are essentially global. They're not within any particular jurisdiction. So we need, at a global level, to get regulators to work together to have a consistent approach to regulation. A point that was also made in a recent IMF blog a few days ago. So thank you. That's the end of my talks. I'll be happy to take questions. I'm not sure if there's any immediately, but happy certainly to take some when we reach the question and answer session.
Okay, thank you, Alistair. It's very interesting about speaking about your research about digital technologies. We know that digital technologies have advanced more rapidly than any innovation in our history, maybe. And by enhancing connectivity and then financial inclusion, access to trade and public services, this technology can be a great equalizer. And I think your presentation, your research actually related with the previous research from Dr. Francesco Saverio Spantilla Lopez. Okay, once again, thank you very much, Professor Alistair Milne. Distinguished guests, ladies and gentlemen, moving right along to our next presentation. That will be delivered by Professor Jonathan Williams from Bangor University, UK. Professor Jonathan Williams is a professor of banking and finance at Bangor University, UK. He is an editor and world banking expert, while he is director of the Institute of European Finance and chair of the European Association of Teachers of Banking and Finance. And his education background, he had a PhD in economics from University of Wales, and his research interest is empirical methods to measure the impact on bank performance public policy, ownership structure, and board level characteristics. And his paper, published in many reputable journals such as European Financial Management, Journal of Empirical Finance, Economic Letters, European Journal of Finance, Journal of Financial Stability, International Review of Financial Analysis, and many more. And Jonathan will deliver his research about the fintech, the perfect day or walk on the walk slide. Please welcome Professor Jonathan Williams.
Thank you, Tiffany. What an excellent introduction, and good morning to everybody. It's so good to be here and see so many friends. Please allow me to share my screen if I may. Okay, can you see my screen, everybody?
Yes, perfect. Clear.
Okay, fantastic. Well, thank you for giving me the opportunity to speak to you all this morning. It's a great pleasure to be here, to be back in Indonesia again, and to be amongst friends. The talk that I'm going to give to you is, as Tiffany has said, it's called Fintech, a Perfect Day or a Walk on the Wild Side. And it comes from a book that I've recently been a co-editor of alongside Severia. And it also includes a chapter by Alistair. So thank you very much, Alistair. I have a copy of the book here, but you can see the picture on the slide. For the purposes of the chapter, I was tasked with examining the light and dark sides of fintech through the lens of super regulatory agencies such as the Financial Stability Board. And these agencies are responsible for monitoring the impact of developments on market structure and how these changes could impact on financial stability, which is something that Alistair has just touched on in his presentation. Therefore, my focus in preparing the chapter was to identify key areas of debate from a high level and to collate evidence on how the market structure is evolving. It's too early to say how the market structure is evolving. There are severe data constraints which is preventing researchers from bits of, well, certainly cross-country comparisons. But nevertheless, I've evaluated the impact of fintech on banks' business models. I've looked at the rate of fintech adoption across countries, the evolving financial ecosystem and the nature of competition, alternative credit markets and fintech behavior, and lastly, a scenario analysis. The evidence presented on the slide here tells us about the impact fintech has been having on banks' business models. And on the left-hand side, we see some evidence provided by the European Banking Authority. And it's survey evidence, and it's showing the impact that fintech is having on banks' business models. And the main areas in which fintech is having an impact is in payments and settlements, and secondly, in retail banking. And the graphic shows that 61% of respondents believe that fintech's challenge is going to lead to a decrease in bank revenue in the areas of payments and settlements, and 47% decrease in the areas of retail banking. And these findings are reaffirmed by other survey evidence, which has been put together by Petralia et al. It's a survey of respondents working in banks, working in fintechs, working in big tech companies. And the survey has attempted to ascertain which fintech products and services are most affected by technological developments now, likely to be affected in the next 5 years, and which are seeing the greatest competition. And the results are remarkably similar to what the European Banking Authority have found. The first financial product and services that is being affected by technology relates to payment services, Then second, products and services under maturity transformation, which is akin to the retail banking also found by the EBA. And finally, forms of information processing, which are facing digital disruption. The survey by Petralia et al. Has found that technology has enabled improvements in service quality and also led to a better understanding of consumer behavior. Looking further afield, technology is expected to improve regulatory and security processes for detecting and preventing fraud. There is some evidence from Indonesia, which I believe you either know or you will be interested in. And there's a study by Fan et al. In the Pacific Basin Journal in 2020. And of course, as you will be aware, there's been a rapid growth in the number of fintechs in Indonesia. And their impact on banks has been to exert downward pressure on banks' net interest margins, on bank profitability, and on banks' yields on earning assets. But what's interesting about the study by Fan et al. Is that they find that this effect is particularly pronounced at smaller banks and older banks. Whereas at younger banks, the authors find evidence of a positive performance alongside this increase in the number of fintech firms. And the implication suggests that the younger banks in Indonesia can be expected to successfully adopt new technologies. In terms of fintech adoption, EY provide an international perspective. And there is also a statistic provided by the Global FinTech Index, which tells us that by 2022, 60% of global GDP will be digitized. And across economic sectors, growth is going to be driven by digitally enhanced offerings, operations, and relationships. We shouldn't think that banks have stood idle whilst fintech has been developing. It's important. Banks have got a history of embracing technology and making it work for them. Therefore, banks have been digitizing and they have been offering their own fintech services. And this is helping to drive fintech adoption rates. The slide shows you which countries have got the highest rates of fintech adoption. And at the top, we find China and India with an 87% adoption rates. I should point out that the EY study focuses only on 27 countries and Indonesia was not amongst those countries. So you can place Indonesia on that table later on. Having said that, whilst adoption rates are highest in emerging markets, there are also high levels of fintech adoption in some of the industrialized markets, such as the Netherlands, UK, and Ireland. And part of this has been driven by open banking. And mentioning open banking leads us into the evolving financial ecosystem and nature of competition. As we are aware as students of banking and finance, banks have market power which derives from their role as licensed deposit takers. Banks have a special status in the economy through intermediation and their roles in the payment system. Banks are protected by government safety nets. And because of this, customers trust banks. They may not like banks, but they trust them because there is a regulatory architecture which is intended to stop banks from failing and to keep customer deposits safe. But threats have emerged which will challenge banks' role as trusted advisors to what is a loyal customer base. There's not so much evidence that bank customers readily switch. And the challenges come from platformization and also open banking, which has been mentioned this morning. And with open banking, banks are required to share customers' financial data subject to customers' consent. And this is important because it's going to end banks' monopoly on their ownership of customer data. which in turn could constitute a significant shock to banks' business models. And there is literature which is looking at which firms might come to dominate open banking. And there's two propositions which are presented in this literature. The first suggests that large banks could come to dominate, and large banks are in pole position. They are the current owners of customer data. They have excellent financial acumen. They have sufficient capital to respond to developments, and they are experienced at complying with regulations. On the other hand, and the firms which have been developing the platforms are the big tech firms, and they don't have the financial acumen, they don't have the compliance with regulation, but what they do have is they have IT capabilities which can replace financial know-how. And researchers are debating whether or not customers trust big tech more than they trust banks. I think that will waver, and it will also depend on which customer segments you ask the question to. Notwithstanding, open banking is going to require substantial investments, and this increases the likelihood that large banks and large big techs will partner up, and any unoccupied spaces could be filled by smaller fintechs. Thus, we are seeing a transformation in the nature of competition from a situation where fintech and banks might compete for market share to a process of collaboration where the fintech and banks realize the benefits of partnerships, through to a situation of what's called co-opetition. And in this stage of competition, fintechs and banks would compete aggressively in certain areas, whereas in other areas, they would cooperate. This suggests that there is room, and indeed there's plenty of evidence to suggest that fintechs and banks have been partnering up. And the slide shows some of the benefits and risks to banks and fintechs from partnership arrangements. One of the benefits on the slide, which has come from some work by Cabo Vivaldi et al., is that banks could partner with fintech as a defense against the impending entry of big tech. However, there is also other evidence that suggests that partnerships between fintech and banks don't necessarily produce the intended outcome. And the evidence on the right-hand side of the screen, taken from a survey by Capgemini, and it suggests that from the perspective of fintech firms, there are significant cultural gaps between fintechs and banks. And these cultural gaps, I think, are reminiscent of some of the differences that we've observed between investment banking and commercial banking in the past, where one likes to take risk and one is completely risk averse. The cultural gaps represent many challenges fintech firms find in dealing with banks. And I think it's important to remember scale here. The fintech innovators are largely small, and they will be trying to do business or enter partnerships with larger banks. Therefore, they face challenges in finding the right people in banks to speak to. And if they find the right people, those people in the banks may not be high enough in the bank hierarchy to take ultimate decisions. But the survey also finds the Achilles heel of the banking system, and that is banks' legacy IT systems. Although banks have invested heavily in their front office operations, their middle office and back office operations remain burdened by legacy IT. There's an interesting study which sheds some evidence on the value to banks of engaging in R&D and developing their own fintech products and services. And the study is being written by Chen et al. It's being published in the Review of Financial Studies. And what Chen et al. Have done is to estimate stock market reactions to the filing of patent applications. And there's a couple of interesting statistics which shed light on the importance of innovation. For the innovators, the estimated median value of a fintech innovation is $46.7 million US dollars, and the data are US. And that compares to a median value of 3.1 million for other financial innovations. And for the financial sector as a whole, the most valuable fintech innovations are the Internet of Things, $24.5 billion, robo-advising, and blockchain. The study also finds that value effects for the financial industry are negative when innovations come from young, non-financial startups that are bringing forth disruptive technology. Yet, market leaders in the financial industry suffer less harm from disruptive technology when those firms are heavily invested in their own R&D. There's been an emergence of alternative credits. This slide shows some of or it ranks some of the leading countries in the provision of alternative credit and splits alternative credit into credit provided by big tech firms and fintech firms. The final column shows total alternative credit as a percentage of domestic credit, total domestic credit from banks. And we can see that these markets are small. But alternative credit also raises some interesting questions. Which customers do new entrants serve? Do new entrants help improve the credit standing of customers? And do new entrants attract and serve unbanked or underbanked customer segments? And if that's the case, then there is an implication for access to financial services, which in turn will have a positive effect on financial inclusion. There is a great paper actually by DiMaggio and Yao, and they've looked at the activity of fintech lenders in the market for unsecured personal credits, again in the US. And what they find is that fintech firms have an aggressive pricing strategy, and this is to attract new customers. Initially, fintechs lend to customers who have been rejected by banks. But once fintechs have established themselves, they then grow their market share by moving to more credit-worthy borrowers. The fintech, on average, charges a higher price for its credit, on average by 3%. But in areas or in regions where fintechs originate less than 20% of loans, they charge less. So there is less difference between what the fintech charges and what the bank charges. And that is fintech's way of trying to gain customers. The study also reveals the difference between hard information and soft information. As we are aware, fintechs make use of enabling technology to provide a better estimate of customer creditworthiness and so forth, whereas traditional lenders rely also on soft information. For the fintech firms, their technology allows for a better prediction of default probability. And even though the loans granted by fintechs have a higher default probability, their pricing strategy takes this into account. Therefore, with borrowers more likely to use fintech for repeat loans, which positively affects the lifetime value of loans, excuse me, the higher defaults or the higher predicted defaults don't produce worse outcome for fintech lenders. The final piece of evidence in this jigsaw is a scenario analysis which has been produced by the Basel Committee for Banking Supervision, and they identify 5 forward-looking scenarios and associated risks. The first scenario suggests that banks will come better, they respond to their business models by reinvigorating themselves with enabling technology. In the second scenario, banks face an increase in competition from challenger banks, from neobanks. In the third scenario, there is a fragmentation of financial services and banks partner up with tech companies. The fourth scenario is where tech firms take ownership of customer relationships and they use licensed banks to provide regulated business. And in the final scenario, it's the end of banking and balance sheet intermediation, a complete platformization, although platformization does fit in with this fourth scenario. Of course, it's too early to say what's going to happen, but there is evidence of things happening in each of those scenarios. For example, there's plenty of evidence of banks trying to become better. Banks are digitizing and they are modernizing. For the new banks, well, there's evidence of challenges from neobanks and challenger banks in the Netherlands, Germany, the UK, China, and the US. For the distributed bank, well, there's plenty of evidence of joint ventures, partnership agreements between banks and fintechs, although as I have said, they're not always successful. And for the regulated bank scenario, the big techs are using their social media platforms to collect and leverage customer data to offer customers tailored financial services from other providers, which includes banks. So this is platformization. And lastly, in the disintermediate bank stage scenario, which might seem far-fetched, but nevertheless, there are examples, including the development of peer-to-peer platforms, which can implement credit scoring and approval processes that are trusted by customers, and cryptocurrencies being used for payments and value transfers using distributed ledger technology. And we've even seen countries allowing remittances to be paid in Bitcoin. So what are the key takeaways from this review of the evolving market structure? Well, fintech is fast growing and has many benefits. There are potential for known and new risks to emerge, which would threaten financial stability. But fintech is not yet at a scale where it constitutes a systemic risk. The financial ecosystem and nature of competition is evolving. We've seen the development of platformization and open banking, which constitutes a significant challenge to banks. But banks are seasoned. They're seasoned at embracing technological developments and making them work for themselves, and they are seasoned at complying with regulations. Therefore, banks are in a pole position with much to lose. And because of that, one might expect to see banks and tech firms competing vigorously in some segments whilst partnering in others. So that is the end of my presentation. I'd like to thank you for your time. Thank you very much.
Thank you, John. Excellent, very interesting about your research, speaking about fintech. As you mentioned earlier, that fintech is fast growing and offers many benefits. Maybe before we move to Q&A session, there's a question that I would like to ask to Professor General Williams and also Professor Alistair. We know that established banks are facing growing competition from hundreds of fintech companies, telecommunication companies, and also technology giants, which have recently started payment services. So how are banks nowadays facing these digital competitors? Maybe Alistair or maybe John, you would like to answer first?
Alistair, would you like to go first?
Okay, I'll kick off on that. I think this came out quite clearly from John's excellent presentation. It's really quite a varied picture. I think you have to look at different areas of bank services. Certainly in the payments field, there are a lot of, there's particularly international payments. So I know for in Europe, competing institutions like Revolut and Wise are taking a lot of international payments, which used to be very lucrative for banks, away from them. And there's some evidence in the UK that new challenger banks, which are technology based, so they're sort of often just purely internet banks, are beginning to make more headway. It's been a slow start in the UK. That most people we have a saying in the UK, I think the statistics are true, that people divorce more frequently than they change their banks. But there's evidence that's beginning to change. I think it's partly a younger generation who are more comfortable with they don't need a bank branch. They're quite happy to do banking on the phones. But I think the lesson I draw from that is it's quite a varied situation. I think you have to look at one country to another, one product to another. And my judgment is that yes, it'll be a continuing story of incursion into bank revenues that will probably play out over the next 2 decades.
Okay, thank you, Oscar. Maybe John, you want to add some information or add some answers?
Yeah, I'll just add a perspective, if I may. I think banks, as I said, banks are in pole position here. They've got significant amount to lose, and banks they've built up their position over years, and I can't see them giving up easily. The banking has been subject to many technological developments, which were supposed to be the end of banking and so forth. But going way back in time through to more recently, the introduction of the ATM, banks have adopted technology, embraced it into their business models, and used it to enhance their positions. And I think that will happen again. I think we have to remember the scale of banking. Just looking at the percentage of alternative credit to total domestic credit, it's still very small, very, very small. And we have to remember that the fintech companies are startups, and the evidence that we're seeing, or some of the studies I referenced, we're seeing small fintechs. Banks are either going to buy the fintech, take an off-the-shelf one, put it in their business, make an equity investment in the fintech, and some entrepreneurs might want that. That's a feature of innovation. Entrepreneurs develop new projects, take it to an appropriate level, and then sell to the highest bidder, and then go back in their shed and make something new. So I can see that banks will find a way, whether it's through partnerships, alliances, they will find a way to embed the technology and to make it work for them. But the caveat is that banks are burdened by their legacy IT. For years, banks have been simply adding patches to their systems. And if I may, I can share an anecdote. Someone told me recently that there's a large bank and they have one guy who wants to retire. And he is crucial. He is the one person in the bank who knows all the patches throughout their system. And if he leaves, they've got an issue. But for banks, they keep offering him more money, and he say, "No, I don't want more money. I want to retire. Please leave me." But no. But that's the issue for banks, I think, is that they really, some of them really need to start again with their IT. But that would be disruptive and costly, so they have to work through that. Possibly the biggest challenge comes from the big techs and their platforms and their use of social media to keep sending you all these messages telling you what you need. So again, it's big business. It will find a way to partner up and divide the pie. I think that's what financial history tells us.
Okay.
So I'd add one very much agree with what John's saying, and add one other point. Again, it's a sign of how complicated the landscape it is. I think I would give a slightly different answer for emerging markets. The reason being that in Indonesia and other countries, there's still a substantial issue about such a high proportion of the population being unbanked.
Okay.
And I think the implication of that is actually quite a positive one for banks, because there's more pie to go around, so that there's less need to fear a challenge from fintechs. I think the experience in Kenya, I think, is quite a positive one from this perspective.
Okay.
I think initially the banks were very reluctant to and trying to resist the development of M-Pesa, the very successful digital money. But actually the evidence, as I understand it, suggests that actually the banks have benefited commercially, because M-Pesa has brought many more people into the financial system, and they've moved from becoming M-Pesa customers to becoming bank customers. And so though they may lose their control over payments, that can bring many other benefits. So but again, it's quite context dependent.
Yeah. Okay. It's really great to have a new perspective from both of you. We know that this digitalization should be seen as an opportunity to boost growth and improve service, rather than only as a way of cost saving. And nowadays, banks should engage in collaborative activities with new market entrants to foster digitalization and to stay competitive. Okay. Thank you. For answering my questions. Actually, questions have come in from the Q&A feature. I would like to open question from Mr. Rama from Bank Kalbar, West Kalimantan. This question addressed to Alistair. Question is, personal data security in fintech lending is one aspect that needs to be further strengthened. So this is because many cyber crimes take advantage of people's personal data. So how do we secure it?
So that's a good question and an increasingly important issue. And I think there's two sides to this. It's which are closely related. So one, yes, as the question highlights, is about security of data, and I think customers, have a right to know that when they provide data, that it's not going to fall into the wrong hands, that their privacy is not going to be breached, they're not going to be subject to fraud and so forth. The other side of the coin, which I think needs to be dealt with at the same time, is that data, and this came up in John's talk, is data is also at the heart of competition in financial services. And the view that's taken in Europe, and I think it's one that can be recommended, is that, and particularly in the UK with open banking, is that data belongs to the customer. So it's the customer should have the right to share that data and allow whoever they want to access it, in order for them to be able to cater to their financial needs, offer them products and services. I think that I'd link the two, because I think it's about ensuring. I think the tools are out there. The tools of cryptographic security are actually very strong. I mean, you can't prevent every vulnerability. A particular problem we have in the UK are older customers, maybe not very technologically sophisticated, and becoming a bit more vulnerable, and they can have telephone scammers who persuade them to hand over bank details, and that's quite a substantial problem. But I think I'm actually quite positive. I think it is something regulators have to take a close concern with. But I think there are plenty of tools available. We can develop cybersecurity in a way that will both protect customer data, but also allow that to be shared appropriately. But it's substantial investment. It's going to be a period of time, I think, before we reach a situation where we're entirely. I wouldn't be happy with the situation at the moment, but I think in 5 to 10 years it will be considerably better.
Okay, thank you, Alistair. Okay, next questions. Next question for us to John from Mr. Ariza Ramadani from Ministry of Finance of the Republic of Indonesia. The question is: as the financial ecosystem evolving, do you think new fintech companies or new entrants will continue the aggressive burn rate to drive growth? Do you think this strategy is sustainable?
Could you repeat the question? It didn't come across very clearly to me.
Oh, okay. As the financial ecosystem evolving, do you think the new fintech companies will continue the aggressive burn rate to drive growth? Do you think this strategy is sustainable?
John, do you want to kick off?
Yeah, okay. I think the evidence that I showed from the US was that the fintech firms were being quite aggressive in their pricing strategy. But the evidence also showed that once the fintechs had proven themselves, they moved away, or they moved into servicing more credit-worthy borrowers. And I suspect that's likely to happen everywhere. And some of the points Alistair's just made is supportive of this as well, because as firms evolve and as firms mature and want to stay in the market, they can't be aggressively pricing all the time. If you think that there's a slight parallel in the market for syndicated credits, where the syndicate has used fine pricing to win the customer over. But in that situation, the lead managers of the syndicate, they are fine pricing or narrow pricing in order to develop a relationship, because they've got other products and services that they want to sell to the customer. And I think that's important. That's showing that, okay, I can give you a nice price, but I want something back in the future. I want to develop a relationship. And in banking, we have this difference between relationship banking and transactions banking. Perhaps the fintech innovators, they're still quite small, and if they continue to be aggressive, is it sustainable? Well, they need to generate income to move on to the next stage. I should think perhaps initially that firms are aggressive, or let's say they price finely in order to get a deal with someone, and then they will seek to work a deal, work a relationship, and that might then lead them away from or into a relationship. So I think with all of this, for the questioner, I think we have to think, what is the objective of the fintech firm? Do they want to embed themselves, or do they want to develop their product and then sell that product on? It's different layers here.
Again, I'd agree with John. It's a question of the maturity of these innovations, and at the early stage, when people are, when there are new opportunities, you expect to see many aggressive competitors, but eventually platformization will dominate. It'll be a few solutions that come to that are successful. Most will fall by the wayside, and I think at that point they're going to be more concerned about making money, protecting their own position. So I think it's aggression at these early immature stages, and much more caution by the survivors later on.
Okay, thank you, John, and thank you, Alistair. Okay, maybe a last question for this first Q&A session. The question first to Alistair. Question is, would like to hear your thought about what kind of fintech regulation should be the government, or maybe they should be the regulators from an emerging country with a shallow financial market and relatively low financial literacy should have, considering the trade-offs you explained before. Thank you.
Yeah. So I'm talking a bit off the cuff. I think it's an excellent question, because I think it's important to look closely at the challenges. Every country, every jurisdiction has different challenges. So my initial thoughts, and I need to think about this properly, but Yes, there are particular problems of financial education and financial inclusion in emerging markets. By the way, they're not absent from developed countries either, but they're definitely bigger. I think it's so that you have to be important not to neglect this conduct of business responsibilities. So there must be a danger of overlending and so on. So I think that there will be a need to focus perhaps more than we have to in the West on the conduct of business objective to make sure that's not leading to undesirable outcomes. I think Kenya, recent stories, examples I've heard there is that M-Pesa has been a great success, but credit built on M-Pesa, there are examples of clearly lending that should never have taken place. How do we get the balance right between making sure that we're not hindering innovation, but we're still protecting customers? Then I'd step back to the point I made in the presentation, that and this is about supporting the ecosystem. It's making sure that it's all open data, standardized data, so that regulators can quickly identify if there are, it should be possible for any regulator to link the amount of credit to evidence on the income of an individual and see whether that's actually in line with their expectations. So it's a big data challenge to get it right.
Okay, thank you, Alistair, and thank you, John, for having this discussion. It's really interesting. Maybe we should have more discussion next. Once again, please give applause to our speaker for the first plenary discussion, Professor Alistair Milne from Labour University, UK. And we have Jonathan Williams, Professor Jonathan Williams from Bangor University. And we have Dr. Francesco Saverio Stantala Lopez from University of Rome, Italy. Once again, thank you very much. You are very lovely speakers. Okay, distinguished guests, ladies and gentlemen, moving right along, we will move to our next plenary discussion, our second plenary discussion. But maybe I would like to remind you that do not forget to fill the form attendance in this plenary discussion to get your electronic certificate at the end of the webinar. So our next plenary session, I would like to introduce you our first speaker for the second plenary session. We have Dr. Inka Yusgiantoro from Indonesia Financial Services Authority. Dr. Inka Yusgiantoro is head of research department in financial service sectors, Indonesia Financial Services Authority. His education background, Doctor of Philosophy from Cornell University, USA, and he also as research fellow at John F. Kennedy School of Government, Harvard University in 2011-2013. And some of his papers have been published in some international reputable journals, such as International Economics and Research in Business and Finance. And Dr. Inka Yusgiantoro will present about what can big data tell us about loan default, lending rate, and loan amount from fintech peer-to-peer lending in Indonesia. Please welcome Dr. Inka Yusgiantoro.
Okay, thank you, Bu Tiffany. Good afternoon, everyone. And good morning to all the speakers and participants from UK, Europe, and Indonesia. I'm very delighted to be a part of this event among the prestigious speakers and my esteemed colleague, Professor Alistair, Professor John, Dr. Saverio, and Dr. Ruth. Nice to see you all again in this forum. I would like to take this opportunity to present our research work that we have just completed this year. And it's actually a joint collaborations between the Department of Research in Financial Services sector and the Directorate of the Fintech Regulation, Licensing and Supervision here at the Indonesia Financial Services Authority. So I would like to thank my colleagues from the Directorate, DP3F, Pak Tris Yulianta and his team for supporting us in this with the data and many intensive discussions over the last 6 months. And I also want to thank my co-authors, Indra Tumbelaka and Hanif Ashar in this project. You can see a working copy of our paper in our OJK website under research. So since this is a country-specific study, I would like to give you a quick background regarding the large digital environment in Indonesia. We can provide significant potentials for fintech peer-to-peer lending development. So the ever-growing financing needs from the populations and businesses like MSMEs across the country would require new alternative sources of funding. And the presence of fintech P2PL in Indonesia since 2016 should continue to fill in the gap, the gap that traditional financial institutions cannot provide, particularly the underserved and unbanked populations. So the demand is real, it's here, and it will continue to grow from 170 to 200 million people that have potentials to fill in this demand, particularly that Indonesia is one of the largest social media users in the world, around 170 million people. We also have close to 130 million people in Indonesia making digital payment transactions, and fintech P2P lending has also provided such payment transactions online. So let me give you another look at the landscape of the fintech P2P lending industry in Indonesia, and this will also be the basis of our motivation to do this research. Since formally regulated and supervised by OJK in December 2016 through the regulations number 77, POJK 01/2016, the P2PL industry has really grown triple digits, and only last year was down to double digits, as you can see in the chart on the right top side of the slide. But the trend has picked up again since the beginning of this year. Nevertheless, this infant industry, I call this infant because it's only been 5-6 years running, but it was only in existence very shortly compared to one in the US, UK, or China that has existed over a decade ago. So we would expect some issues over how we should govern its lending rate, whether we should set a market rate cap or leave it to the market, and then also what we can govern on the loan amount, and also pretty much the whole market structure of the industry. Since 2019, Fintech P2P Association, we shorten it AFP, has set a lending rate cap policy and has been put in place in the code of conduct of the association at 0.8% per day. And I think we've reverted this to the UK's fintech P2P lending regulations back then. Then in February 2020, came also a moratorium by OJK, which suspends all registration for new platforms for fintech P2P lending. And at the time, we in early 2020, we have about 164 platforms. Now, this day, we only have about 104. So, last but not least, basically, what we need is a regulatory framework for fintech P2P lending, and currently it's under review, including the exit and entry policy, lending rate caps, and also maximum loan amount at 2 billion rupiah. So from that motivation, we've tried to formulate our research questions here. The first is, what is the market structure for the fintech P2P lending in Indonesia? Second, what is the ideal number of platforms in the country? And what factors affect the loan quality of the fintech P2P lending? Do characteristics of the borrower and loan matter? Do borrower and loan characteristics and economic conditions affect fintech P2P lending rate and loan amount. Last but not least, we want to ask how fintech P2P lending rates and loan amount, whether it should be regulated or not, and if it should be regulated, then what is the optimal level for the lending rate and also the loan amount. So we did some literature review, and pretty much these are the few strands of the literature for P2PL. I think John and Alistair have shown some literature on P2PL. But here we want to divide up into two strands, and one is about market structure, and also second on the loan default, loan rate, and also the loan amount. For the loan, for the market structure, the question to be addressed is whether the P2PL industry is a substitute or a complementary product for the traditional banking industry. And here we found that from Morse et al. In 2015 and also Lu et al. In 2020, they found that for small credit, P2PL is a substitute for banks. Nevertheless, for Inval et al. In 2016, suggests that there needs to be more new empirical studies for the specific market structure on fintech P2PL. So this type of study so far has been non-existent. So we are here to fill in this gap in the literature. So going forward, I believe there are a lot more research work coming out on P2PL, particularly in Indonesia and China, as what also has been mentioned by Alistair. One of the reasons is basically because we have large P2PL markets potentials in Indonesia as well as China. In terms of loan default, lending rate, and loan amount literature, Lin et al. In 2017 have found that some borrowers' characteristics play an important role in determining loan defaults, while our internal study at OJK in 2019, published by Santoso et al. In 2020, we have found that additional characteristics from the borrowers have influenced lending rates in the P2PL industry here in Indonesia. So here is the descriptions of the sample data. We've taken the sample from 20 fintech P2P platforms that comprise more than 70% of the loan market in Indonesia, and that would translate to around 14 trillion rupiah of outstanding loans. And then the data period that we obtained is from December 2017 to April 2021. Do note that all these platforms were only in existence in 2015, and then 2016 that's the end of 2016. That's when we issued our regulations. So, but I think with this data, we have covered enough for 41 months of data observations. And then we gathered two kinds of data. One is a platform level data, and we gathered it for the financial informations to address the first questions of our research on market structure. And then the other types is the loan level data that we use to address the second, third, and fourth research questions on determinant factors on loan default, lending rate, and loan amount. Overall, I believe this is a big data problems. From the 20 fintech P2P platforms, we have collected about 8 to 9 millions of data observations, and by winsorizing the data, we have at the end about 5 million data remaining to be used in our estimation model. So moving on, I would like to share with you two models or three models that we used in this research. The first model we used for the platform level data, and here we want to address the market structure issue for the fintech P2P lending industry in Indonesia. And first, we found that it's to solve the optimal number of platforms in the country is a very difficult exercise. So our pragmatic approach to this problem is to look at the market structure using the data to formulate some index and indicators. The index, we use learner index so that we can measure the efficiency of each platform and consequently observe their level of market power and competition. And then after that, we use a Boon indicator to measure the market competitions through their marginal cost. And last but not least, we also use Panzer rows or edge statistics to identify the market's competitiveness, whether they are monopolistic, oligopolistic, or a competitive market. Now, for the other questions, we use a second and third model using the loan level data. So here we have three models, to address factor-specific characteristics of the borrowers. And the first model here is a Tobit regression model to estimate the borrower's days past due. So here, days past due, or DPD, is a dependent variable that we relate to various variables, such as the lending rate, denoted by R, loan amount, L, and covariates for loan and borrower's characteristics, denoted by X, and dummy variables for lending rate cap policy, D, and also macro variables denoted by letter M. So please forgive us, we write the specifications of the model here in simple matrix form. So maybe if there are students out there that might be confused, the constants are actually on the right side of each variable. But this model is very granular, using days past due from the maturity date of the loan term to the actual payment date. So we compute DPDs since the first day of your loan is overdue. So we can accommodate the lateness of the loan payment, so we can detect loan risk better than computing just the probability default of the borrowers. Now, the second and third model below, it's the basis for measuring using the loan level data. And here it's very similar to the first model, but where we define similar variables. And here, without repeating again, the covariates for the borrower characteristics, we have 9. We use gender, marital status, age, education, income, residential ownerships, financial institution loan history, default loan history, and also authentications. And for the loan characteristics, we have 6 variables, and they are lending rates, loan amount, loan period, loan purpose, that we divide up into multi-purpose and also financing purpose, and also whether the loan has insurance and also collateral. So let me show you the descriptive statistics. Here we are looking first from the platform level data. Here, the highlight of the statistics here is that the fact that the average income for fintech P2P lending is still at a loss of 1.5 billion rupiah per month, as you can see at the bottom here. And also, if you look at the asset as well, or equity, the minimum you still see a negative equity in some platforms. The next description is on the loan level data. Now here we can highlight the average outstanding loan at the top, which stands at that the mean stands at 350 million rupiah, while the maximum, of course, according to the rate cap set by the association, is 2 billion rupiah. Here, the other characteristic variables, again, as I said, we have 9 and 6 for the loan and borrower's characteristics. Education here is a dummy variable, where if borrowers have bachelor degree, minimum of bachelor degree, it's 1. And then residential ownership is also a dummy variable. If you own a house, you're categorized as 1. And I think here, for the residential ownership, it's the mean is 0.21, which is basically a lot of borrowers don't own a house. I think we have a lot of millennials still living with parents or just renting the house. Financial institutional loan, if borrowers have existing credit and have existing credit in another financial institution. Default loan history, that's also a dummy variable. If borrower has a historical default in P2P or other institutional loan. Authentications, it's when you submit applications for P2PL using your national identity card or video call, that's 1. Loan purpose, we divide that into multi-purpose loan and financing loan. Insurance, If you have loan insurance, that's a dummy variable for one, and also collateral. It's also one. Do note that if you have cash loan in P2PL, you don't need collaterals. But for some productive loans, or most if not all productive loans, you need collaterals. And definitely another highlight here in this descriptive statistic is DPD, in which you can see here that the average is about 18.5 days after due date. So in average, yeah, borrowers actually they have paid their loans late, as opposed to their the date that they're supposed to pay. Okay, okay, this is a very important slide that I want to share with you. Actually, from this slide is what we can conclude, for the lending rates and also for the loan amount. Here is we gathered all the data and we classify into 4 different streams with DPD 0 days, below 30 days, between 30 to 90 days, and above 90 days. And here you can see for the mean lending rate for those 4 brackets, it's between 0.392 to 0.470. So later on in our last slide, in the conclusions, we will extend this the interest rate cap, and just by using this descriptive statistic, we can push forward for a lower rate cap than 0.8%. For the mean loan amount, you can see here in the dashed line here that for DPD 0 up to above 90 days, it's between 1.1 billion rupiah to 1.4 billion rupiah. So that's quite relatively lower than the maximum loan amount of 2 billion rupiah. So later in our conclusions, we will also grab from this findings that I think the maximum loan amount should, I think, remain capped at 2 billion rupiah. So let me share with you the findings. So this is, you can see later the estimation results, but this is sort of like the wrap up for our findings for the market structure. For the learner index, we found that it's evenly distributed around the mean at negative 0.3790. So the negative results, basically implies that platform revenues are still not able to cover the expenses currently. So this is in line with the descriptive statistics that the platforms are still inefficient. And but however, with through time, with a lower marginal cost, they can increase efficiency in terms of their costs, and which subsequently can raise the market share. For the Boon indicator, the marginal cost coefficient is also negative, as expected. And for this indicator, that results in a competitive market share. For the Panzer rows, the value that we got is 0.8537, which shows that basically the market is competitive. So you can look at the details of the results here. Here, if you see the tables here, it's evenly divided for efficient and inefficient platforms. So the efficient platforms pretty much is basically those platforms that have positive learner index, whereas the negative learner index is basically the inefficient platforms. But then if you can see the 10 platforms between the 25th and 75th percentiles, the middle pack here is the range is very small, and dominated the sample. So we see that actually there remains some room, to further improve the efficiency of the P2PL industry in Indonesia. For the Boon indicator, next, it's we see that we focus on the log MC, or the marginal cost, and we see we have a negative value and significant. So which means that we have a competitive market. Last but not least, for the results from the Panzer rows indicator, we have what we need to focus on is the combinations of the log W1 and W2, which shows around 0.84, and that's pretty much close to 1. So the market is quite competitive. So last on our findings on the results for the loan level, this is a wrap up of the results. Higher lending rate increases days past due, while lending rate cap policy in 2020 has effectively reduced days past due and lending rates. In terms of the characteristics of the borrowers, higher income significantly increased days past due. Sorry, higher income significantly decreases days past due, but loan default history significantly increased days past due. Longer loan terms increased lending rate and loan amount. In addition, younger borrowers receive lower lending rates and loan amount. And then higher income receive lower lending rate and higher loan amount. Last but not least, loan amount does not affect DPDs and lending rate. So all these findings are consistent from all samples for consumptions, working capital, and other purpose loans in the data. So these are the specific results. I don't have to, just to save time, I don't need to go into details, but you can study this when we give out this presentation materials to everyone in this forum. So here you can see that the lending rates here have a positive significant value, to the loans, to the DPDs, and also the lending cap policy here. It's also has a negative relationship with the days past due and income, and also the default loans have each have significant values, significant relationship with days past due. So this is in terms of days past due. Next is in terms of the lending rate as our dependent variable. We have the lending cap policy also affecting significantly to the lending rates, as well as the age. The older you are, like myself, John, and Alistair, the higher lending rate that we'll get. But for the income, for the younger generations, because the lower the income, you have the higher the lending rate. Finally, we have the loan amount here, marital status. So actually, financial institution status is significant, and also income is also significant. So let me finalize this with my last slide here to conclude our research and give you some policy implications. We see that the fintech P2P lending in Indonesia is a competitive market, but the platforms are in the process of increasing their efficiency. And then when we use days past due as a proxy for lending default, the characteristics of the borrowers, such as income and default history, are important determinant factors for the lending default. Higher lending rate can increase lending default risk, while lending rate cap policy decreases the loans days past due. Then lending rate cap should also be extended with lower rates, and that was less than 0.8% per day, which actually just last month, the association has reduced this lending rate cap to 0.4%. So that's very in line with the results of this research, while the maximum loan amount at 2 billion rupiah should be maintained. So that's all we have. I look forward to the discussion sessions. Thank you. Merci. Grazie. Terima kasih.
Thank you very much. Please give virtual applause to Dr. Inka Yusgiantoro. Thank you for sharing the slides. We will discuss more in Q&A session later, Dr. Inka, because we still have one more speaker in this second plenary discussion. So our next speaker is the one only woman, the one only woman here. It's really great having you, Dr. Ruth Takning from Université de Limoges, France. Dr. Ruth is a lecturer in economic science, faculty of economic science, and an active researcher in LAPE. Université de Limoges, France. Her education background, she has PhD in economics from Université de Limoges, France. Her research interests inclusive growth, SME finance, microfinance, household finance, financial stability, about bank risk and performance, and her research published in some international reputable journals Managerial Finance, Journal of International Financial Markets Institution and Money, World Development Review of Behavioral Economics. And her presentation is talking about what drives Bank Fintech Alliance evidence worldwide. Please welcome Dr. Ruth Technic.
Thank you very much. Can you hear me? Yes?
Yes, excellent. Perfect.
I'm trying to see whether I can control. I seem to not be able to move the slides. Sorry.
Yeah.
I can't move the slides.
You can move the slides. Maybe one of. Okay. Can you move the
Or
slides now?
probably just let me screen share.
Is it operated by yourself or by the control room?
I'm going to share screen. I think it's better.
Oh yeah.
Can you?
Yes, I can see clearly.
Yes. So today I'm going. First of all, I would like to thank OJK for organizing this very interesting Fintech Research Symposium. Today I'm going to discuss about the factors that drive bank fintech alliances. So this ongoing research is a joint work with Professor Tarazi and Dr. Pierre Nicolas Reo. Okay, so just to give you a brief background regarding this research. So this is just the first part of two studies that we want to undertake regarding bank fintech alliances. So this paper focuses on the drivers, and the next project, I'm not going to discuss today, but the next paper normally that we plan to write is on the effect of bank fintech alliances. So this helps us or help the audience and readers to understand why banks form alliances with fintech firms. So when fintech firms, especially crowdfunding and peer-to-peer lending platforms, were just starting to emerge, there was a fear about their impact on incumbent banks. So this is not surprising because the global financial crisis in 2008 eroded consumers' trust in financial institutions, and policymakers' response was, of course, tighter regulatory constraints for banks, which created a large regulatory gap between banks and the new financial service providers. So along with technological innovation, these events paved the way to the growth of disintermediated credit. So this is partly also in relation to what Professor John Williams talked about a while ago. He provided interesting statistics saying that fintech firms have impact on banks' business models, especially on payment and retail banking. So here I'm just going to first discuss about the effects of fintech lenders on banks. So we ask here the question, are fintech lenders competitors for banks? So let's see the literature. I have not listed the theoretical work of Thakur and Merton, but I'm going to discuss about it anyway. So Thakur and Merton in 2018 had an interesting theoretical work on examining the impact of trust in lending. So they argue that banks, of course, have funding cost advantage, being able to collect deposits from customers, but fintech firms have the upper hand with regard to regulatory, lesser regulatory burden, and of course, some technological innovation. So they found out in their work that when borrower defaults erode trust in lenders, banks are able to survive the loss of trust but fintech lenders cannot. Okay, so here they're just trying to stress the importance of trust dimension, especially when comparing fintech firms and traditional banks. So empirically, so we have had several research, high impact research on the impact of fintech lenders on incumbent banks. We have Tang 2019, who used a regulatory change as an exogenous shock to bank credit supply, which forced banks to tighten their lending criteria. So she found out that following the shock, peer-to-peer lending platforms increased their lending, but only to inframarginal borrowers, or what we call as low-quality borrowers, who banks stop lending to. Thus, she found fintech lenders, substitutes to banks, but only at this particular customer segment. So here she used US data with peer-to-peer lending data from Lending Club. So there are similar studies, for example, Deror, Pelizon, and Takor in 2021, but focusing on German data. Okay, so they find that when faced with higher regulatory costs, peer-to-peer lending grows, and that peer-to-peer lenders are found to be bottom fishing, as they offer lower risk-adjusted interest rates than banks. Okay, and of course, there's some the research by Cornaja, Wolf, and Yo find a causal impact of peer-to-peer lending competition to the unsecured consumer loan market in the US, and Blasek and Putter finding a relationship between the use of crowdfunding linked to firms having a relationship with a stressed bank. Okay, so this point out, which is also related to what Professor John Williams talked about a while ago with respect to the impact of fintech, especially on retail banking. Okay, so so what has been the response of banks? So if we use the argument of both and Thakor, when faced with competition, banks tend to invest in increasing the value of their relationship loans. So it's not surprising that banks have been focusing on know your customer relationships and efforts in order to increase the value of their relationship loans to existing clients. But beyond providing alternative funding options, fintech firms have the capacity to reshape business activities, especially in the provision of payment services, risk management, and in improving operational efficiency. So the literature generally defines three innovation strategies linked to what we can expect from banks. So the first one is to make or produce products themselves. The second is to buy or acquire. And the third is to ally or develop partnerships. So our focus is on the formation of bank alliances with fintech firms. So digitalization has forced banks to reconsider their corporate boundaries and make them more permeable to market interactions. So compared with making the products themselves or acquiring fintech firms, strategic alliances are more permeable, they are more flexible solutions, which reduce technological and market risk. And of course, it allows them not to make mistakes, to reduce the probability of betting on the wrong horses. Okay, so here are two figures describing a fintech ecosystem of BNP Paribas, which is the largest bank in France in terms of activity. So the upper portion depicts the different partnerships between BNP Paribas and French fintech companies. So, of course, you can remark here a lot of fintech, bank fintech partnerships. And we can see below, okay, I'm not sure if it's very, very clear, but we see at least 5 relationships in terms of bank fintech alliance in terms of investments, meaning banks investing in fintech firms. Okay, so gone are the days when we look into fintech firms as mere competitors. More and more, we see banks forming alliances with fintech firms. And of course, it is important to note that forming alliances is not only beneficial for banks, but it can be also beneficial for fintech firms. So why do banks form alliances with fintech firms? So I'm just going to briefly discuss three examples here. We have BNP Paribas partnering with Forcha Financial Solutions, which is a regtech, okay, aimed at enhancing compliance and standardizing regulatory processes. So this is an example of a strategic alliance. Banks like BNP Paribas have established incubators and accelerators to enable innovation while maintaining control through minority stakes in fintech firms. So there's also a Bank Central Asia in Indonesia, okay, who engaged in signing off a semi-loan disbursement with a fintech company that provides some digital funding platforms. And of course, there are strategic collaborations between United Overseas Bank with a crowd funding platform, our crowd. So here, now we look into why do banks form alliances with fintech? So again, it's related to what Professor Williams said a while ago. He said a while ago that citing Cabo Valverde in 2021, he said that it's probably a defense of banks to the arrival of big techs. Okay, so here I'm just trying to enumerate some of the challenges of big tech to fintech firms. So of course, their entry into finances numerous benefits into greater innovation and efficiency and financial inclusion, especially in emerging and developing economies who extensively use their services. So let's not forget that big techs have extensive customer networks. So regulators seem to be more concerned with the financial service offerings of big techs for fear that they might dominate and not simply diversify the provision of financial services. So of course, they have great big data analysis capabilities, and consumers in general are happy to embrace fintech offerings of big tech firms. A Capgemini survey indicated that 74% high net worth individuals would be happy to enlist big tech firms for their wealth management needs. But of course, as stressed a while ago by Professor Williams, it depends on the segment, and at the same time, it depends also on the market. So, for example, there are markets who are wary of data privacy reasons and are not very engaging with respect to the big tech services. But of course, in emerging and less developed economies where financial inclusion is very important, this, big techs entering the market provides an opportunity. So of course, the fintech firm's smaller size could also be a strength. Fintech firms usually deliver significant technological advancements by focusing on one critical aspect of a challenge rather than overcoming barriers to achieve enterprise-wide solution. Here, it's normally a very informative table showing that, of course, big tech firms have the advantage in all dimensions, across all dimensions in terms of trust, leverage, and performance. And the way for banks to compete with big tech firms, if ever they're going to dominate or start providing a lot of financial services, would be to cooperate with fintech firms. So banks plus fintech, in general, if we see this table, they're still in a bit disadvantageous situation, but it's their best chance probably as a defense against big techs. So what are the arguments from the literature? So there's Brandl and Hornoff in 2020, stressing that banks are more regulatory constrained, and FinTech Alliance therefore allows them to confront the threat of technology-driven firms, since fintechs are more agile and innovate faster. So Hornoff et al. Argue that alliances are results of mutually beneficial transactions, wherein both fintechs and banks could achieve synergies together by improving their market values. First, fintech firms can broaden their customer base, especially when we talk about firms or corporate. Okay, and they can also obtain benefits from a banking license, and at the same time, it enable banks to maintain their customer base and secure exclusive rights to specific applications. So, if we look into the literature on the drivers of bank fintech alliances, there are two studies which are related to our work. There's Brandl and Hornoff who investigate bank fintech relationships in Germany using bank fintech network analysis. So they find that most collaborations between banks and fintech in Germany take the form of product-related collaborations, wherein fintechs develop special algorithms or software related in order to increase the efficiency of the provision of financial services. Hornoff et al. 2020 empirically examined the impact of banks' digitalization strategy, bank-specific characteristics such as size, profitability, and they also examined the impact of the announcement of bank fintech partnership on the share prices of banks. So here they focus on bank fintech alliances in Canada, France, Germany, and the UK. So the objective of our paper and our contribution is to investigate the forces driving bank fintech alliances using a sample of 53 countries worldwide. So we examine the impact of existing bank and fintech regulatory and financial landscape on bank fintech alliances. So here we focus on the establishment of regulatory sandboxes as opposed to, let's say, innovation hubs or other regulatory approaches. So we used the establishment of regulatory sandboxes because in our opinion and in general, this type of regulatory approach involves a lot the regulators. So let's because I don't have a lot of time. Sorry. I do. Okay. So our sample consists of 2,484 banks located in 53 countries. So we focus on commercial bank holding companies, savings banks. But for business checks, we also check just commercial banks with complete data on bank fintech regulation and other related variables. We also perform robustness checks on around 1,800 banks in 27 countries where a bank fintech alliance was recorded. So we identified around 612 bank fintech alliances, majority of which are alliances with market support services like RegTechs, for risk management purposes, etc. And then next, around 20% on alliances with payment fintech firms, 20% also with alternative funding fintechs. So our study period is 2015 to 2019. So we use some logistic regression. So we define alliance which is a binary variable equal to 1 from the year the bank formed at least one alliance through investment or partnership with a fintech, and 0 before the fintech alliance, and for banks who never formed any fintech alliance. So we also have different variations of our dependent variable, looking into the total number of alliances by year, the total number of new alliances by year, and also looking into alliance by segments. So when we are taking count numbers or discrete variables such as the total number of alliances or the total number of new alliances, we use the random effects negative binomial regression. We also tried other techniques, but this technique gave us the best BIC, or the Bayesian information criterion. So what are our primary results? Okay, so we find that banks with larger market shares seem to partner or form more alliances with fintech firms. Inefficient banks also form alliances with fintech firms. I didn't anymore emphasize your bank size because it's something that has been already established in the literature. We also find the establishment of sandboxes positively linked with forming alliances with fintech, as well as some capital stringency, which confirms the theory that regulatory burden can be a factor actually for banks to form alliances with fintech firms, because in general, fintech firms are less regulatory burdened. So, okay. So we also looked into the interaction between fintech regulation and capital regulation stringency. So what we find is that even though capital stringency seemed to encourage banks forming alliances with fintech, the existence of both fintech regulation through the establishment of a sandbox and capital regulation do not drive fintech bank fintech alliances. So we see here that it's only positive and significant the formation of bank alliances when capital stringency is high in countries where regulatory sandbox do not exist, confirming again the theory that regulatory burden could be really an important factor for banks forming alliances with fintech. So we also look into the impact of profitability on banks forming alliances with alternative funding platforms according to level of income diversification. We find here that banks with which are more profitable tend to form alliances with alternative funding platforms, but only for those who have higher loans to total assets. I'm going to skip some, but here is probably a very important result regarding the interaction between financial market sector characteristics and bank market share. So what we find is that an increase in banks market share, okay, increase the probability of banks forming alliances with payment fintech firms when the financial market development is relatively low. Soundness of banks is very low. The availability of venture capital is low, which kind of like confirm what Professor John Williams said a while ago also, that banks tend to perceive fintech as a threat to market share. So in order not to lose market share, they are forming alliances, especially with payment fintech firms in countries where financial market development is low. Sorry, I'm going to conclude. So as a conclusion to our preliminary results, we find that bank capital regulation stringency and the establishment of regulatory sandboxes to drive bank fintech alliances, but not both. Bank capital regulatory requirements increase banks forming alliances with alternative funding platforms. Large banks, banks with large market shares, and more inefficient banks are more likely to form alliances with fintech firms. And the higher a bank's market share, the more likely for the bank to form alliances with payment fintech firms in countries with low level of financial market development, probably to achieve financial inclusion, but of course not to lose some market share. Confirming a while ago, I think there was some Q&A um, with a question posed to Professor Williams a while ago on this subject. So thank you very much.
Thank you very much, Dr. Ruth. Please give virtual applause to Dr. Ruth. It's very great to hear perspective about this. So we move to our Q&A session, and we're also glad that Professor Saverio has returned to join the Q&A sessions, because many questions are also addressed to Professor Saverio, especially those related to cryptocurrencies and Bitcoin. So maybe the first question in this session addressed to Dr. Saverio from Mr. Dani, Bank Sumatera Utara, from North Sumatra Bank. The question is, Bitcoin and other crypto are very free transactions. We can lead to money laundering and abuse. So what is your opinion regarding this? We saw that at the beginning of the month, Bitcoin fell very far, causing future contracts to be liquid. So please answer the question.
So yes, in fact, we have some research about that. I mean, one of the most relevant paper we had now is a paper published, I think, in RFS, Review of Financial Studies, last year, which actually shows exactly this, that the large portion of Bitcoin was in fact used for money laundering, and that's indeed a big problem. Indeed, this is something that need to be addressed in some way, so is indeed, I mean, this is a thing which comes with privacy, right? So, and Bitcoin doesn't have like the same level of privacy as cash does. So of course, I mean, we can argue that cash as well can be used for money laundering, right? So, but this is a thing that is true. I mean, there is nothing to say about that. I mean, the only thing is that is it like something which is a characteristic of Bitcoin? So we can really define Bitcoin as the money as the kind of currency which is used for money laundering, which make it easier to launder money. I'm not sure. I mean, it's this is something that is indeed a matter of research. So what was the second part of the question again? Sorry.
Yeah. Sorry. Excuse me.
Sorry.
Okay. Yeah. Bitcoin and other crypto are very free transactions. We can lead to money laundering and abuse. So, what your opinion? We saw at the beginning of the month, Bitcoin fell very far, causing future contracts to be liquid.
Yeah, exactly. So that's I think a most important thing. So that's exactly what pushed me to study like the basically connection between future price and spot price. So the idea is exactly this, that there are some kind of level. I mean, I think what is key in these markets is that most of the exchanges allow investors to use very large amount of leverage. So it's not unusual to see things like 100x leverage, meaning that with basically 100,000 you can invest up. I mean, with the 1,000 you can invest up to $100,000 in Bitcoin, which is a lot of money, which is a very high level amount of leverage, which basically can, in some way, I think this is my view, but I think it's kind of shared in. I mean, this can trigger some very high fluctuation in the value of Bitcoin, and so I agree with this. I agree in the sense that basically this kind of abnormal volatility in Bitcoin may be partially driven by the existence of these future contracts, and that's also what makes them very interesting to my point of view. But indeed, this is exactly where my research is going. So I want to basically find some empirical, strong evidence, cutting-edge evidence about this phenomenon. So I want to see if indeed the volatility of Bitcoin is somehow caused by this triggering of these large future contracts. At the moment, I don't have a real clear empirical evidence. That's why I didn't present anything about that, but that's where the research should go in the future, yes.
Okay, thank you, Professor Saverio. I want to apologize. It's a little bit noisy here. It's because one of the conditions that I cannot control. So maybe you hear a little bit noisy. Okay, so maybe we move to other question addressed to Bapak Inka. to Dr. Inka. This question coming from Miss Indah from Andalas University. Speaking about the research of P2PL, do you think P2PL adoption for MSMEs is the hot issue that still need to explore? Since we know that MSMEs still have a limitation in accessing finance, so is P2PL is the answer?
Yes, thank you, Bu Tiffany. My answer is yes. Yeah, and as I've shown in the my presentation material in the beginning, the gap is still huge, for the demand from MSMEs on financing. So that's why P2PL can fill in that gap. If you own a small pawn shops, or for those really small MSMEs out in the regions, you don't have much options, to get some funding, to expand your business, or or maybe even to operate or to have additional goods, So you can rely on the local loan sharks, or maybe the rural banks may give you some loans, or but I think there's still limitations on alternative sources of funding for the small MSME. So that's why I strongly believe that P2PL industry can fill in that gap. And just by providing not only providing the financing the SMSE need, but also in a faster and more efficient way, that they can do it online. They can without coming to the office and doing face-to-face interview. So and the loan can also be made available at a much faster rate than bank loan. So yes, the answer, and I strongly believe that it will be a big part in the future.
Okay, thank you, Dr. Inka. I have another question for you. Actually, it doesn't relate it with your presentation. It doesn't relate it to your slides, but I think it's a very interesting question coming from Mr. Muhammad Iman Ma'ruf from UIN 1 Tulungagung, Jawa Timur. So how does Indonesia with the G20 respond to Bitcoin, which other countries accept and some reject? What will OJK do, legalize or reject it? Thank you very much.
Okay, that's a very good question. I know it's off topic. I think maybe Dr. Saverio can help me just on a general answer. But let's think about this. What we need to do is define what we mean by digital asset first. But for me, I think it's best to define it into three classifications. So the first is what's so-called cryptocurrency or digital currency. And in Indonesia, based on the law number 7, year 2011, on mata uang on currency, it states that all citizens, or all transactions must use rupiah, in domestic market. So to transact using Bitcoins, it's not legal. Okay, so and this is all under the jurisdiction of Bank Indonesia, and I think the stance for OJK is that we follow Bank Indonesia's regulations and stance. Second classification is what we can call crypto securities. So that's under our jurisdiction. Securities is under the supervisions and regulations of OJK, and we based it on the sort of like the old law on capital markets in 1995, which is overdue. But in that law, there's no classifications of assets for crypto assets. So it's not legally available yet that the crypto securities can be traded in the capital markets. Indonesia, as all other countries, we have to do according to the legal foundations, legal basis. So we have to be careful on that. And the third classification is definitely what we call crypto commodities, and this could work under the jurisdictions of the Bapepti, the Trade Ministry. And I think in the past year, a lot of people have already trade crypto commodities through Bapepti, and I think that's where you also trade Bitcoin as a crypto commodities, not as a crypto securities or currencies. And but I think this remains a challenge for all of us, particularly also the ministries and also the authorities for OJK and also Bank Indonesia to sit together and I think and talk about this, because it's this is a lot of overlappings, between jurisdictions, and it's also very important for everyone in this forum to note that it's not trading crypto or digital assets is not as wonderful or as beautiful as you see, with the high rates of high trends, significant triple digit returns, but you have to make sure too that what is the underlying of the asset. So because a lot of the cryptocurrencies, they don't have underlying assets, and that's what's concerning from the central banks as well. Of course, this is what we call the democratization of money. This all is coming out of 2009 because of the global financial crisis in 2007 to 2008. Where people they want no control over from the government, right? They want freely to trade using digital assets, but just do note that what the underlying is.
Okay, thank you, Dr. Inka. Maybe I will go to Dr. Saverio, since it's your field. Speaking about Bitcoin, maybe you want to add comments about this question, please. Okay, is Dr. Saverio still with us? Hello? Oh, okay. I think he's missing. Okay, Dr. Saverio, are you with us? Okay. Maybe while we're waiting for Dr. Saverio back to our Zoom, the next question. Questions have come in also for Dr. Ruth. Hi, Dr. Ruth. The question is...
Hello.
Yes, this question is addressed to you from Mr. Abdul Aziz from Swadaya Rural Bank. So the question is, we support and welcome to fintech, but what about our customers who doesn't understand or who don't understand about technology? I think it's quite challenging, and it's a big homework in the context of financial and technology literacy.
Thank you for your question. I think it's very, very important to emphasize the role of financial literacy and digital literacy for that matter. And I think that the OJK is stressing the need for financial literacy as more and more technological innovation through fintech firms are emerging. So I think that they need to be more informed. I think that there should be more efforts from regulatory authorities and perhaps also universities to form alliances or to collaborate with the OJK, for example, and regulatory authorities in order to provide or improve financial education across consumers, especially those which have relatively lower levels of education. This is very important because they have to know, of course, some risk-return trade-off. It's very possible that they might be very attracted to very high interest rates without necessarily knowing that it's also linked with higher risk, of course. So I think that recently there were a lot of illegal peer-to-peer lending platforms in Indonesia, and I think that OJK has implemented or established some regulations in order to combat this. So I think that universities, regulatory authorities have to join hands in order to achieve financial consumer protection.
Okay. Thank you, Dr. Ruth. I still have question for you. Okay, the question from Mr. Surasi Hutama from the World Bank. As staff from rural banks, what should a rural or a little bank in Indonesia do to survive in the era of big tech and fintech?
Yes, I think it's a very, very important question, because it's true that there were findings in the US, for example, that it affected small banks, especially in less competitive markets. I mean, the arrival of fintech firms. However, it could be both something that is good or something that is bad. But I think that rural banks first have to define who are their customers. Okay, so maybe they can accompany their clients toward more digitalization, maintain and improve relationship with them, and perhaps improve also the way for them to have better customer experience. What else? I think it's mainly that, to develop the relationship that they already have, because at the end of the day, compared to fintech firms, banks still have larger customer base, especially with regard to firms. Or maybe if you look into the agricultural sector, farmers, or who are normally the clients of rural banks, is just to go back to the core business of rural banks and just improve this. Okay.
Okay, thank you. I think I see Dr. Saverio has returned. Hi there.
Sorry, I just had to go to the room 1 second.
No, it's totally fine. It's totally fine. Okay. Actually, I had question addressed to Dr. Inka, and I would like to hear your comment about this, about the question. Okay, maybe I repeat the question. Okay, how does Indonesia with the G20 respond to Bitcoin, which other countries accept and some reject, legalize or reject?
Sorry about that. Sorry, I couldn't hear you. I couldn't understand your question.
Okay, you cannot hear me? Okay.
Yes, better now.
Okay, with the G20 respond to Bitcoin, which other countries accept and some reject? So legalize or reject it. What do you think?
So I don't think Bitcoin. I mean, so the problem with Bitcoin is exactly this. I think so. There is a problem. I mean, it's borderline to what extent can be regulated. So the big deal with Bitcoin and what makes really Bitcoin different. So I mean, we had digital currency in the past, we had experience in the past, but the problem with all these other kind of experiments was exactly that we had like a central authority, normally a company or a private company, issuing this kind of token and selling this kind of token as a product. And that's what we have seen in the past. Bitcoin is extremely different from this. So what Bitcoin is that decentralized, so it is basically some line of programs, I mean, installed in different computers around the world. That's at the center what Bitcoin really is. And that means that basically it's really difficult to stop it, right? So it's very difficult to regulate it, because basically you should know where these line of codes are, and basically they could be on our phones. So basically you can regulate basically the way we use Bitcoin. I mean, you regulate the wallet. I mean, you regulate the means we use to actually use Bitcoin. You can regulate mining, because these are big farms in which, in fact, that what we have seen recently in China, they regulating the mining, meaning, I mean, ruling out the mining in China. You can regulate exchange, but the core of Bitcoin, of course, Bitcoin relies on mining. So if you could around the world stop everywhere mining, that could stop Bitcoin. But the point is that, can you do that? So can any regulator, can we have such a coordination around the world to have a unified regulation about Bitcoin all around the world? That's what we would need to basically really regulate Bitcoin. And this is something that I think requires an effort for the regulators, which we haven't seen in the past. We have seen some kind of coordination in banking that required a lot of effort for many different countries, many different institutions. We have, I'm not sure we can see, maybe if these things become a very important, regulatory pressure, a regulatory need, we might have this kind of effort around the world, but I don't see this happening very soon. Let's put this way.
Okay, this is why you have to set the perspectives, right? Okay.
Yeah.
Thank you, Dr. Saverio, and to our speakers for this session. Actually, our time is very limited, but before I end this Q&A session, I would like to ask last question. This question refers to our speakers in the second plenary discussion, second session. Okay, the question is just simple. If in the past and currently the competition between banks and fintech companies is to compete for a feasible but unbankable market, how will competition in the future be associated with millennial and again Z generations who have less direct contact with the banks? It's simple, but yeah. Okay, maybe I start with Dr. Inka first.
Oh,
it's really
I'll
good question.
be the last because I have to think about this.
Okay, I think it's simple, but it's actually hard question, right, Dr. Inka?
Yes.
Okay, maybe ladies first, Dr. Ruth.
Hello. Yes. So my thinking is that this probably emphasizes the threat of big tech firms, because of course they have large customer databases and large customer bases, especially the millennials using extensively their services. So I think that banks have to step up, probably form alliances with fintech firms, and try to act now, because of course the big techs showing interest in the provision of financial services already mean that they are getting there. So I think that big techs in general have the potential to really disrupt and dominate the sector, especially in low or in less developed economies. So I think that's where we are going. So I think they have to step up. Banks must step up.
Okay, thank you, Dr. Ruth. Maybe Dr. Saverio. It's quite challenging, actually. Yeah. What about your comment?
So I think that basically, I'm very passionate about competition. I think competition is really the core of any capital system. So competition should be something that we, all really care about in terms of research, in terms of, stimulating competition. And I think this is also a very dear argument and dear topic for the European Commission in general. And I think that's a very good news. I think we don't have. I'm in Italy. My point of view from this country. I used to live in the UK. I lived in the UK for many years. In fact, both my son and my daughter, they were born in the UK, and what I've seen in the UK is was a higher level of competition in the banking system when compared to Italy. And I think consumers benefit in some way from that. So I think if fintech can increase the competition in the banking system, in the financial system, is going to be very good for consumers, first of all. And I think also this is the starting point, and I think from here we should look at in which way fintech can in fact increase the level of competition. And I think for sure, in this is my take about this. My take is that for sure it's about the level of fees we're going to pay. Since the fintech is going to be more automated, so we are going to be bigger investment in fixed capital, which come at the beginning, but we can, sometimes you can consider that as a fixed cost, as a sunk cost. So the way they produce this service is going to be more efficient. So this probably will bring down some fees, some cost of the fees, which I think is going to be very good for the average person in the world. So in that sense, that's also why I'm passionate about fintech, because I think it can really improve the way the way financial intermediation works in general. So, and especially when it comes to the fees we pay in many different arguments, I think these are still inefficient, especially again in some countries. So when we bank transfers, for instance, in some countries are still very inefficient. Also, there are many fees that you can, keeping a banking account in some countries, in some countries has a very high cost. And this is also something that I think it's inefficient, and that's why that comes down to the unbanked that you mentioned before. So the fact that this is very costly. If you think that a banking account could cost something like $5 or $10 per month, it's a lot of money for some people. So that's why this could create could marginalize some potential users. And I think what fintech can really do is bring down this cost of which sometimes represent some entry barriers from some kind of consumers. And I think that would be very good for our society.
Okay, thank you. Very interesting, Professor Saverio. Okay, Dr. Inka, I assume that you have collected the answers.
Okay.
Okay, please share your opinion.
Bu Tiffany, don't you want to hear from John first and leave me last?
Oh yeah, still.
Yeah, John's still
we
here.
Still have, yes, we still have
Go ahead,
John.
John.
Wow. Hi, John.
I'll go
You're
last.
still with us. Okay,
Thank
maybe
you.
John, you want to share your thoughts?
It's a great discussion. It's a great question, Tiffany. There's lots of angles to this. I think Ruth and Saverio have given some very good answers. I'll just be a little bit more cynical, if I may. Your question, you referred to millennials. I think the benefits of fintech to customers is that the products are easy to use. The decision times are quick. So people are now used to getting hold of one of these things and doing this and so forth. Yeah, sure, it's attractive. But when you're talking about people's money and people's life savings, there is evidence, certainly in the UK, that whilst customers will do business with a fintech bank, with a challenger, have an account there, they are still retaining accounts with their banks. So you can see that customers are using the fintech product for convenience, but they're not putting all of their life savings in there. Now, for millennials who might prefer the ease of living on their phone and so forth, I'd be a little bit cynical and say there have been scandals surrounding some fintech firms such as Wirecard in Germany. I'd say surrounding big tech, there are now concerns about it could be let's say the market power and the intentions of the big techs. We could say that banks don't fully internalize the benefits of society from bank lending, but I think banks appreciate that more than the big tech firms who are profit maximizing. So whether you trust some of these powerful guys who run big techs, I'm not so sure. Could be a generational thing. But if there is any scandal, or if there is a shock and people suddenly found that what they thought was safe on their phone has been hacked, stolen, their information not protected properly, that might cause a bit of let's call it a mean reversion, a reversion back to, well, we know banks are safe. Why were banks built in solid buildings? Well, it's to protect your valuable assets. So I can see that sort of behavior coming back into fore. And as the millennials get richer, are they going to keep all of their money in a tech company? The way the regulations will develop will have something to say about that, of course, but there could be a reversion to type. And just to touch on the Bitcoin issue, which Saverio was asked, I think simply from a monetary economics perspective, central banks want control of the money supply. Therefore, there is no, why would they want Bitcoin to become, or any other digital currency to become part of the money supply when they can't control it? I think our friends in China, for instance, are very concerned about financial stability. So I think that partially explains their attitude towards Bitcoin. And then if we take our friends in Ecuador, I think it's Ecuador, they are now allowing remittances to be paid in Bitcoin. But that's because Ecuador doesn't have its own currency anymore. They dollarized back in 2000, I think. And Ruth's made the point about the fees, and Saverio too, about fees being charged for remittances. Banks are abusing their market power there. The fees are expensive because there is no competition. And Saverio did make the point about how enthusiastic he is for competition. And if there is a way for banks' market power in remittances to be eroded so that these remittance fees come down, then all well and good. But the Ecuadorians have chosen Bitcoin as the vehicle.
Yeah, okay, the key is the financial
Inca
stability.
can have his say.
Okay, thank you very much, John. Speaking about millennials, that I'm sure all those who present here are millennials in their time, of course. Okay, maybe I will go to Dr. Inka. Please, Dr. Inka.
Okay, thank you, Tiffany. I think everyone just sums it up all fine. It's John, Ruth, and Saverio has really brought up a lot of keywords. I think, but overall, I think what we've seen from all of our presentations, one of the keyword that has been mentioned a lot of times is competitions, and I can relate this to what has happened in Indonesia, and I had the opportunity actually to be in one of the task force developing the regulations for the P2PL Indonesia, OJK 77 back in 2016. So in early 2016, when bunch of millennials came to our office and asked them to be regulated by us. So at the time, the questions were even from our colleagues from other ministries and even within OJK were wondering whether it should not be regulated at all. It should be like in China, where P2PL industry at the time was not regulated. But now, moving forward 5 years, I think we had the best stance to be regulated from the beginning. But the competition was there. Banks were worried at the beginning, whether they become the disruptive technology can disrupt their business, and there has been the arguments for the first several years, whether fintech will overcome or will reduce significantly the market share of the banking, but at the end, in the last several years, the competition is no more of an argument. It's more of collaborations between fintech, P2P lending, and banks, and they can facilitate each other, for banks to channel their credits to further to the unbanked or underserved in outer regions or outside Java. And then also for millennials, who tend to be more technologically savvy, and they want everything to be faster, more efficient. And I think the P2P lending can facilitate that better than banks. So banks should be able to work and penetrate in millennials market through P2P lending. But I think John raised up another good issue too in terms of macroeconomics and the regulation. I mean, we can talk about this the whole day. We're all lecturers here, professors. I think we love to talk, but I think time is limited. And I just want to say that for the current euphoria of big tech acquiring banks, I think that's the hot topics now in Indonesia. Big tech, has convenience because it's not bounded by a lot of regulations imposed by regulators, but for banks and financial service institutions, it's heavily regulated. As you know, banks is the most heavily regulated industry in the world. Right? So, but I think it's business to business activities. If big techs want to acquire banks, I think it's because they see some potentials, in leveraging the banking system, the payment systems to build an ecosystem, But at the same time, the banks probably would need to inject or raise up their capital So I think it's a win-win solution for big tech and banks. But overall, when big techs jump into the financial services sector, they have to comply with our regulations and rules, and they will be subject to the same provisions, so that we can all have the equal playing field. And just looking over the past 5-6 years, when fintech P2P lending started initially in 2015, and then we started to regulate in 2016. It's all about competitions, banks worrying about disruptive technologies. But then just basically started in just December 2020 when one big tech acquire a small bank, and then later on there's 6-7 more big techs acquiring other banks this year. It becomes that the euphoria becomes very high, for digital banking or neo bankings, but do note that majority of neo bankings and digital bankings, they don't succeed. So you have to be careful on this euphoria on big techs acquiring banks, and we have to be careful on this issue. But overall, I think we just look at the positive side of all the big techs and the P2P lending, trying to basically help us from the financial inclusion side. We have a target of 90% in 2024, and so we have a long way to go. And also for the financial literacy, also I think they can also help us. So it's a two-way field. Not only regulators but also academics and also industry should play a big role in that. So that's all my closing statements. Bu Tiffany, your question is very simple, but it can be broken down to many complex things, as always. Thank you.
That's why I put the question at the end of the Q&A session. Once again, thank you, Dr. Inkayus Giantoro. As Dr. Inka mentioned earlier, that we have to open more discussion space in the future because it's very interesting. Many great points were raised during this session, and I'm sure that there will be various initiatives, thought, perspective that we could do together in the future. Unfortunately, our time is very limited, so we have to close this panel discussion. Once again, please give a virtual applause to our lovely speakers, our great speakers here, Dr. Inkayus Giantoro, Professor Alistair Milk, and then Professor Jonathan Williams. Thank you, Jonathan, for staying with us until the end of the forum. Dr. Francesco Saverio Santolo Lopez, thank you so much. And of course, the one and only ladies here, Dr. Ruth Takning, thank you once again. It's really a fruitful discussion. I wish we have more time to discuss. We are approaching the end of the forum, but I would like to remind you to all participants once again. So all participants here in this forum will receive online certificate. So you have to fill the attendance form. Do not forget. And with that conclusion, the event of Fintech Research Symposium 2021 is now over. We thank you for your time who have participated in this event on behalf of OJK and also when as well pleasure to make a mistake today, and hopefully we can make this journey a good start for all of us. Once again, thank you very much. Good afternoon. Stay safe. See you, everyone.
Thanks, Tiffany. See you, Ruth. Stay safe.
financial industry is undergoing a profound transformation, and digital technologies are reshaping payments, lending, insurance, and wealth management. The rapid development expects financial services in many economic sectors to be more diverse, competitive, efficient, and inclusive. The COVID-19 pandemic has accelerated the digital transformation in the economic sectors. In particular, the need for digital connectivity to replace physical interaction between consumers and providers, and in the process that produce financial services, will be even more critical as economists, financial service providers, businesses, and individuals navigate the pandemic and eventual post-COVID-19. The development of fintech and digital financial services is supported by the increasing internet access and smartphone users in Indonesia. With the collaboration between the government, industry, and stakeholders, we believe that innovation will be created in the digital financial service and fintech ecosystem, supported by good governance and digital financial education and literacy in the community. Together with all stakeholders, Indonesia Financial Services Authority (OJK) organized Indonesia Fintech Summit 2021 from 11th November to 12th December 2021. Indonesia Fintech Summit 2021 is delivered through virtual platforms by presenting more than 70 various promotions, 90 more educational and literacy activities, more than 50 fintech companies, and more than 200 job vacancies at the 2021 virtual job fair. More information regarding the agenda related to the Indonesia Fintech Summit 2021 can be accessed through the official website www.fintechsummit.co.id.